Morning, Michelle. Welcome.
Good morning. Good morning. I appreciate everyone attending. This is our second virtual event. So I'm going to kick us off and get us started this morning. For those that are on the call that I haven't had the opportunity to meet, I'm Michelle Sullivan, and I'm a partner with Freed Maxick. We are pleased to be able to present a nonprofit accounting and auditing update with a speaker that, for many of you that have attended in the past, is familiar with. We have Alan Fetterman with us today. Alan is a former partner in a New York City-based firm who concentrated his career in the not-for-profit industry, serving many clients and being the QC partner, the quality partner at his firm relative to looking at all their not-for-profits. So he certainly has a very diverse and expansive resume for those that have not had the opportunity to meet him. He's been retired for a number of years, but has stayed very active in our profession, not only speaking for our firm, but speaking nationally at various different conferences, and also being strongly affiliated with in his career with the AICPA Not-for-Profit Expertise Committee and the New York State Society. So want to thank Alan for joining us again. As I indicated, this is our second year of having to do a remote session. I think we were really trying this year to try to have this hybrid, but are certainly sensitive to making sure that we do the right things and keep people safe. So I'm going to turn it over to Alan and take my camera and my mic off so that he can be the center of attention here. And again, appreciate everyone taking time between today and tomorrow to listen to the not-for-profit accounting and auditing update. So I'm going to turn it over to you, Alan. Thank you.
Thank you, Michelle. Good morning, everybody, and welcome to the world of virtual webinars. As Michelle said, I had actually, until about 2 weeks ago, expected to fly up to Buffalo yesterday and be speaking live this morning and tomorrow morning, but COVID had other plans for us. So here we are again, and we'll hope that next year we'll be able to do this in person. The session this morning is really going to encompass 3 separate topics. We will start off with a 2-hour nonprofit accounting and auditing update. And everybody by now knows that 2 CPE hours means 100 minutes. After that, we'll take a 10-minute break, and then we'll do 2 50-minute presentations. The first one will be a single audit update, and that will be followed by the new audit report standards, SAS number 134. That's what this morning will encompass. Tomorrow morning, we'll have 3 other topics. We'll talk about those tomorrow morning. So let's get started. As Michelle said and Jen said a few moments ago, if you have any questions, please put it into the chat room. I have 2 computers open, my desktop, which I'm speaking into and looking at the slides. My laptop is next to me. So I'll try to keep an eye out for questions. If I don't catch them, Jen will, and she can read them. But either way, let's get started. Please send your questions if you have any. I'll be glad to try to answer all of them as we go through the material this morning. So Jen mentioned these before. These are the housekeeping notes. Keep in mind that we will come across blue boxes, and those slides will contain a keyword. I will remind you when we get there to make a note of it so you can put it on your evaluation or the participant survey at the end of the morning. So in this session, we will cover FASB and AICPA guidance that's specific to not-for-profit entities. We'll also talk about other FASB and AICPA guidance and projects which will, although not specific to nonprofits, they will impact nonprofits and their auditors. And then we'll spend some time in this session on an audit and attestation update. The AICPA publishes quite a number of nonprofit documents every year, but the 2 I want you to all be aware of is the Audit and Accounting Guide, Not-for-Profit Entities, and the Audit Risk Alert, Not-for-Profit Entities, Industry Developments. Both are published annually. Both have already, the 2021 edition has already come out relatively recently, within the last month or 5 weeks or so. The Audit and Accounting Guide is non-authoritative. Keep in mind that in the United States, GAAP today is set by the Financial Accounting Standards Board. They have an accounting standards codification or an ASC. Only the codification is authoritative GAAP. However, the AICPA, by publishing these audit and accounting guides, which are approved by FINREC, which is the AICPA's Financial Reporting Executive Committee, the AICPA can recommend things that, or processes, or let's call them pseudo-GAAP, that are not contained in the codification, because the codification can't possibly cover every possible transaction that could happen in every possible industry or sector, so that these audit and accounting guides contain recommendations from FINREC in areas not covered by the codification. And there are many, many of them within this audit and accounting guide. Now, the question people ask is, okay, but if it's not authoritative GAAP, do I need to follow it? And the answer is yes. It's not authoritative, it's non-authoritative, but you need to comply with what the recommendations of FINREC are in areas not covered by the codification, just the same as areas covered in the codification. The A&A Guide includes new audit accounting standards updates, or ASUs. It also this year includes a discussion of changes to the Auditor's Report on Financial Statements, which was SAS number 134. We're going to take a deep dive into it later this morning. The Audit Risk Alert, as I mentioned, the latest edition is out, the 2021 edition. This focuses on emerging practice issues in current economic, legislative, regulatory, accounting, and auditing developments. And this year, and nobody should be surprised about that, it includes a lot of coverage related to accounting, auditing, and operating issues due to the COVID-19 pandemic. And we will, tomorrow morning, take a dive into the 2021 edition of the Audit Risk Alert. Recently, FASB came up with a very interesting new philosophy about effective dates for major standards. They created what they're calling two buckets, bucket one and bucket two. Bucket one is going to include all the SEC filers. Bucket two will include all other entities. And since no nonprofits are really SEC filers, all nonprofit entities will be in bucket two. And here's how it will work. The effective dates for what FASB is calling major standards for bucket two entities, that means all nonprofits, will be at least 2 years after the effective date for bucket one entities. The reason for this is FASB is saying, okay, these large organizations, these SEC filers, these publicly traded corporations, they're going to have an effective date for all major standards. Smaller organizations, which is going to be predominantly private companies and not-for-profits, they're going to wait. They're going to be able to wait for 2 years, kind of learn from the bucket one entities that have implemented these standards, and therefore, that takes the pressure off smaller entities. And I know there are some very large nonprofits, but they're not publicly traded corporations, even the large national nonprofits. But most nonprofits are not large nationals. They're small to mid-sized local community-based organizations. So now for our nonprofit clients and our nonprofit organizations, they now have the ability to wait up to 2 years before they have to implement standards after the SEC filers. Now, the question is, what's a major standard? It was not defined. FASB is going to make a determination on a case-by-case basis what's a major standard. Two we're dealing with now for a few years are revenue recognition and leases. Those are examples of major standards. Talking about revenue recognition, let's get into it. This has been around since ASU 2014-09, so it's around for 7 years. Revenue from contracts with customers, what people like to call RevRec. It was originally deferred for a year, and then the latest deferral, because of the pandemic, was ASU 2020-05, issued about a year ago. It provided an additional 1-year deferral for non-public entities that have not yet issued 2019 financial statements as of the date that this ASU came out, which was June 3rd of 2020. And that extension, that 1-year deferral, is now to years beginning after December 15th, 2019, which means calendar year 2020 and fiscal years ending in 2021. For example, June 30, 2021 year ends. June 30, 2021 year ends, we're probably in the process of auditing now or about to begin the audit. Clients are closing their books and preparing for audit. So this is the year they have to implement, years ending December 31, 2020, June 30, 2021. Now, the reference there to non-public entities is interesting. I'd like you to look at the middle bullet here, talking about 2015-14. Public nonprofits are those with publicly traded debt. Some nonprofits do issue public debt, tax-exempt bonds, for example. Or some nonprofits might be what's called a conduit debt obliger on publicly traded debt. Quick example, let's say a nonprofit hospital wants to build a new wing and they need to borrow money from the state. They need to borrow $40 million to build the wing. The state might float publicly traded bonds to the public and use the proceeds to loan the money to the hospital. So the hospital owes $40 million to New York State, but New York State owes $40 million to the public because they're the bondholders, and the nonprofit, therefore, is a conduit debt obliger on publicly traded debt. If a nonprofit is considered public, they are not what's called a PBE on the FASB language. A PBE is a public business entity. Those are publicly traded corporations. But you could have a public nonprofit. So when we look back now at 2020-05, we talk about non-public entities. We're talking about non-public nonprofits. Now, most nonprofits are non-public, so there's no real issue here. But for public nonprofits, they still go back to an effective date earlier than for non-public nonprofits. They've been in effect for a while now. So now let's talk about it briefly. The RevRec standard focuses on contracts with customers. We've called these exchange transactions for many years, and that's still an acceptable term. There are some exceptions to that. For example, a lease contract is not covered under RevRec. It's covered under the lease standard, which we will talk about sometime later in this session. Contributions are scoped out of the RevRec standard because contributions are not contracts with customers. And what the standard does is it establishes a single principle-based revenue standard by eliminating all the previous industry-specific standards for revenue recognition. So now we have one standard. The standard says we'll recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. And it sets forth a 5-step approach for revenue recognition. The 5 steps are simply, number 1, we'll identify the contracts. Do we have a contract with a customer? We'll identify the performance obligations. What is it that the seller needs to do? We'll determine the transaction price. That is what the purchaser is supposed to pay. Then we will allocate the transaction price to the performance obligations and lastly recognize revenue when or as a performance obligation is satisfied. Now we're doing a very, very summary review of this RevRec standard. We've been talking about detailed reviews for years. I'm sure some of you have taken extensive CPE on revenue recognition. So this is really a summary overview of the standard. So the 5-step model highlights the identification of the performance obligations of the seller, the price to be paid by the customer, and then allocating that price so that revenue is recognized as each performance obligation is satisfied. And that, by the way, could be at a specific point in time, such as a sale of merchandise at a specific point, or over time, for example, services that will be provided over a period of time. So for nonprofits, contracts with customers come from sources such as sales of goods and services, fees, tuition, conferences, special events, advertising, royalties, licensing of intellectual property. Pretty much any type of earned revenue, remember, contribution revenue is scoped out. There are certain types of transactions that will require a bifurcation, meaning a splitting up into its component parts, between an exchange transaction and a contribution. The classic example is the special event. Dinner dance. If you pay $250 to go to a dinner dance, the nonprofit is, in essence, selling to you certain things. You're going to get a catering facility, a roof over your head. You're going to get food, alcohol, music, flowers on the centerpieces. So you're getting something for it. Theoretically, the value of what you're getting is the sales price that the nonprofit is selling to. So if you pay $250 to go to a dinner dance and you're getting something valued at $100, we are required to bifurcate it by saying, okay, $100 is really sales revenue to the nonprofit, and $150 is a contribution. And only the $100 sales revenue comes under the RevRec standard. As far as transition into the RevRec standard, we have two approaches. We can take what's called the full retrospective approach, which means there'll be a cumulative catch-up to the beginning of the earliest year presented. And what that simply means, let's assume we adopt it for calendar year let's say for June 30, 2021 year end. But we have comparative financial statements. We're also presenting, for comparative purposes, June 30, 2020 year end. The full retrospective would have a cumulative catch-up to the beginning of the year ended June 30, 2020, which means you're going to really go back and apply it as of July 1, 2019. And both the current year and the prior year, you will apply the standard to all contracts. Under the modified retrospective approach, for the current year ended June 30, 2021, existing and new contracts will be accounted for under the new standard. The cumulative catch-up will be to the beginning of the current year, going back to July 1, 2020, and the prior year, you would still account for contracts under the old or legacy standard. My recommendation, obviously, if I were in practice to my clients, would be the modified retrospective approach, because then the client does not have to go back and restate the prior year. It's a little easier. There are a number of disclosures under the RevRec standard. There's a transition disclosure. We have to disclose the selected adoption method, either fully retrospective or modified retrospective, as well as the quantitative impact of the adoption. And then there are a number of annual disclosures. The five I've listed here apply to nonprofits. There are others that apply to public business entities, more, I should say, more than just others, but more disclosures. But for nonprofits, this is what you have to disclose. I think the one you should look at carefully, the first two, the description of revenue disaggregated according to the timing of transfers of goods or services, whether you're recognizing revenue at a point in time or over time. And by the way, if your nonprofit is a public nonprofit, remember what that means. They issue public debt, or a conduit debt obliges on public debt. They must disclose quantitative disaggregation of revenue, and then some qualitative information about how economic factors affect the nature, amount, timing, and uncertainty of revenue and cash flows. Now, think back to what we discussed just a few minutes ago, the two-bucket approach. This second, and quite honestly, if you look down at some of the other disclosures here, it would really be helpful to look at what publicly traded corporations, SEC filers, are putting in these notes insofar as qualitative information. So you don't have to reinvent the wheel. It gives us nonprofits time to learn about how to draft these notes from SEC filers. FASB published the Revenue Recognition Implementation Q&A. The AICPA publishes an A&A guide entitled Revenue Recognition. This does not come out annually, but 2021 is the latest edition. There's a separate chapter in this guide devoted to not-for-profit entities, which cover things such as tuition and housing revenues, subscriptions and membership dues, and bifurcation of transactions. Now, I do believe that last year at this webinar, I did a session which was a deeper dive into RevRec. We're not going to repeat that this year because you got the information last year and nothing really has changed. But it'd be a good idea for those who are accounting for nonprofits, either internally or as their auditors, to take a look at this A&A guide and look carefully at the chapter devoted to not-for-profits. As far as planning for implementation, my first comment is it's getting kind of late to plan for implementation, but if you're still in that process, make sure you inventory and understand all your revenue streams. And that means going back and reviewing your contracts or agreements. You have to document that you actually have a contract. And if you read the standard, it'll tell you that in order for there to really be a contract, there has to be enforceable rights and obligations. Review your current revenue recognition policies, identify which revenue streams are similar so you can bundle them together, and then perform the analysis of all your revenue streams and reach and document your conclusions on how to account for each source of revenue. When the RevRec standard came out, it ignited a long-standing debate about government contracts. And the question that's been asked for many years, and I will tell you, let me see, I became a partner in my firm in 1979, and at that point the question was already being discussed. Are government contracts exchange transactions, or are they contributions? An exchange transaction would today be called a contract with the customer, or is it a contribution from the government to sponsor some sort of program? A customer is defined in Topic 606, that's revenue recognition, as, and this is a quote, a party that is contracted with an entity to obtain goods or services in exchange for consideration. So the question now can be reworded. Is the government, when they pay a nonprofit to run a program, is that government obtaining goods or services, which makes it a reciprocal exchange transaction, or is it just giving money to support a program, which would make it a non-reciprocal contribution? So here's a quick example. Let's say that the city of Buffalo contracts with a Buffalo Senior Center. No, let's make it a community center because the example is going to talk about teenagers. The city of Buffalo signs a contract with a Buffalo-based community center. The nonprofit community center is going to run a teenage after-school activities program, the objective of which is to keep middle school age children off the streets and safe from the time school lets out until parents come home from work to claim their children. So you all understand what's going on there. The nonprofit will run the program, spend money obviously, and the city of Buffalo contractually will reimburse them for all their expenses, dollar for dollar, up to a maximum or a cap of $1 million for the 10-month school year. So the nonprofit runs, the contracts are signed, the nonprofit runs the program every month. They bill the city of Buffalo. Within a week or two, they get paid. That's a fantasy part of the example. And by the end of the school year, the community center has spent $980,000 on the program, and that's within the budget. And they've been reimbursed $980,000 from the city. The question now can be stated as follows. Should the nonprofit organization reflect that $980,000 on its statement of activities as an exchange transaction, i.e. a fee for service? They sold the service to the city of Buffalo. Or should it be a contribution from the city of Buffalo? That's the question that's been around for many years. When RevRec was issued, the definition of a customer put this discussion in the forefront. So FASB immediately started a project, and they came out pretty quickly with ASU 2018-08, clarifying the scope and the accounting guidance for contributions received and contributions made. The standard applies to both contributions received by a recipient and contributions made by a resource provider. It provides guidance to help determine whether a transaction should be accounted for as a contribution or as an exchange transaction. And while they were at it, they decided to clarify the definition of a conditional contribution, because that has created a lot of confusion over the years since the issuance of FASB Statements 116 and 117 back in the early 1990s. Conditional contribution was defined as a condition was defined as a future and uncertain event that needs to occur to bind the donor. And the word uncertain created the confusion. We all understood what future meant, but uncertainty is, let's just say, uncertainty is in the eyes of the beholder. And what may be certain to me may be uncertain to someone else. And that led to what we call probability analysis. Uncertainty led to people saying, well, what is the probability of meeting that condition? And that created all sorts of different interpretations. We'll get to that. Okay, keyword number one. Remember, Jen told you better make a note of these keywords, and because you're going to have to put them on your participant evaluation at the end of the session. So your first keyword is report. So in coming up with their conclusions, FASB reached 4 key clarifications. And in my mind, numbers 1 and 4 are the 2 most important. Let's go through them individually. The first key clarification is that a resource provider, even a government entity, is not synonymous with the general public. I will tell you, government is not the general public. The government is elected by the public. The government serves the public. The government represents the public, but it's not the same as the public. The public is society. And FASB has decided that if a resource provider receives value indirectly by providing a societal benefit, this would be considered a non-reciprocal transaction, i.e. a contribution. So think of the example I gave you a few moments ago. The resource provider was the city of Buffalo. But who received the value from that $980,000? Society. It was the children and their parents who benefited, which is society. So the city of Buffalo receives an indirect benefit, but the society is getting the basic benefit. So this would be a contribution. Second key clarification. If the primary beneficiary of a grant contract is a third party, a nonprofit should use judgment to determine if the transaction is reciprocal or non-reciprocal. So in this case, the third party is society, and I think the basis of the transaction would make it non-reciprocal or a contribution. Thirdly, furthering a resource provider's mission or feel-good sentiment does not constitute commensurate value received. Now, if you think of, let's assume the resource provider is a private foundation, and they must make a certain amount of grants in order to meet their mission. Meeting their mission does not constitute commensurate value received, so that would be a contribution. And that leads me into the fourth key clarification, which I think is a key one, along with the first one. They're all key, but 1 and 4 I mentioned in my mind are the 2 most important. The type of resource provider should not override the substance of the transaction. What that means in my mind is if instead of the city of Buffalo as the resource provider in the example I gave you before, let's make it a private foundation. Same contract, same program, same reimbursement, but it's a private foundation. I think we would all agree that we would treat that as a contribution by the nonprofit from the foundation. So it's saying here, just because it's a government doesn't override the substance of the transaction. It's a contribution. With those 4 key clarifications in mind, here are the conclusions that FASB reached. If the resource provider is receiving commensurate value for the resources provided, the resource receiving entity should file Topic 606, RevRec, or other guidance such as leases, which would be Topic 842, I believe. And that last parenthetical thing are for organizations that have not yet adopted RevRec, Topic 606, then they're going to go back to 605, which is the old revenue sections. So That's only if the resource provider is receiving commensurate value. We've decided in the example I gave you before that the resource provider, City of Buffalo, is not receiving commensurate value. If the resource provider is not receiving commensurate value for the resource provider provided, then the resource receiving entity should determine whether the transfer of assets represents a payment from a third-party payer on behalf of an existing exchange transaction between the recipient and an identified customer. And the classic example there would be Medicare. Let's assume I go into the hospital. Now, I am covered by Medicare. And my bill is paid to the hospital by Medicare. Now, Medicare is the federal government. And I know there are certain people out there that don't believe that. There are still people who claim, who yell and scream, keep the government away from my Medicare, and they don't kind of realize that Medicare is the federal government. So the federal government has paid the hospital. In this case, the resource provider, which is the federal government, is not receiving commensurate value, but the resource receiving entity, in this case a hospital, is receiving a payment from a third-party payer, i.e., or e.g., I should say, Medicare or the federal government, on behalf of an existing exchange transaction between the recipient hospital and identified customer, which is me. So it is not a contribution. That's an exchange transaction or a contract with a customer. If it's determined to be a third-party payment on an existing contract, again, follow topic 606, RevRec. If the resource provider is not receiving commensurate value for the resources provided, and it is not a payment from a third-party payer on behalf of an existing exchange transaction, then the transfer of assets is a contribution from the resource provider, and the resource receiving entity should follow the contribution model guidance in topic 958-605. And that fits exactly the example I provided before about the City of Buffalo and the Nonprofit Community Center. It would be a contribution from the City of Buffalo. Now, you don't want to call it contribution from Buffalo. It doesn't have to be classified as a contribution on the statement of activities. You can still call it government grants. I don't like that term because governments never grant us anything, but it's a term of art that we tend to use. Or what I like, revenue from government contracts, because that's kind of what it is. The ASU also updates the master glossary of the codification, the definition of contribution and exchange transaction. And you can look at that and see it kind of matches what we've been talking about. The standard requires that an entity determine whether a contribution is conditional based on whether the agreement includes a barrier that must be overcome and either a right of return of assets transferred or a right of release of a promise's obligation to transfer assets. So FASB, once they determine the process for determining whether something is a contribution versus an exchange transaction, if it's a contribution, then we have to look whether it's conditional or unconditional. In order for it to be conditional, there have to be two requirements, a barrier and either a right of return and a right of release. No more probability assessments. Okay? To assess whether there's a barrier in the agreement, the entity would consider things such as the inclusion of a measurable performance-related barrier or other measurable barrier. And some examples are, let's say the agreement says there that we have to achieve a specified level of service or produce an identified number of units of output or have a specified outcome or achieve a matching requirement. I'll give you $1 million if you raise an additional $1 million. All of those are measurable performance-related barriers. Then, the extent to which a stipulation limits discretion by the recipient on the conduct of an activity. For example, a requirement to incur only qualified expenses that are based on specific requirements. That fits exactly what we talked about before. They must spend the money on a teenage after-school activity program. That's a requirement to incur only qualifying expenses based on specific requirements. That would be a classic example of a conditional contribution. And lastly, the extent to which a stipulation is related to the purpose of the agreement. For example, a requirement to write a report that conveys findings from a research grant, that would be a condition. However, that would exclude administrative tasks, such as writing a report indicating how grant monies have been spent, or the contract requires an audit in accordance with OMB guidelines. Those are not related to the purpose of the agreement and would not be considered conditions. So there are three things we have to look for. So, a contribution containing stipulations that are not clearly unconditional shall be presumed to be conditional. And once we've determined a contribution to be conditional or unconditional, then and only then will the entity consider whether the contribution is restricted on the basis of the current definition of a donor-imposed restriction. FASB decided not to change anything about the definition of a donor-imposed restriction in this new standard. The standard also modifies what's called the simultaneous release option, which allows a nonprofit to recognize a restricted contribution directly in net assets without donor restrictions if the restriction is met in the same period that the revenue is recognized. For example, organizations that in the past get very, very few restricted contributions, and all of a sudden they get a restricted contribution, they spend it immediately. They've had the option ever since FASB statement number 116 back in the early 90s to treat that as if it were unrestricted, treat that contribution. Of course, there should be a note to the financial statements explaining that accounting policy, and they have to be consistent. But this standard modifies that. It creates two buckets for restricted contributions. The first bucket, those that were initially conditional, and the second bucket, all others, which would really mean those that were initially unconditional. This ASU allows this option to be elected for bucket one and not for bucket two. And let me explain why. Just lost. Give me a moment because oh well, my laptop something just jumped on and I lost so I don't have Jen, I do not for the moment have the chat room in front of me. Something somehow jumped onto it, and so at this point, we're going to go without the chat room. So if someone has a question, Jen, would you please read it to me?
Absolutely, Alan. No problem.
And during the break, I'll see if I can figure out why I lost the chat room. Okay, so this ASU allows the option to be elected for bucket one. For organizations that used to treat government contracts as restricted contributions, as exchange transactions, and now they have to treat them as restricted contributions by electing the simultaneous release option for these types of government contracts, which are almost always conditional. They can treat them now as similar to the way they treated them when they treated them as a fee for service, report them in the net assets without donor restrictions. Again, they need to disclose the accounting policy. There are no additional recurring disclosures in this standard, but if you recall, for conditional promises to give, recipients have always been required to disclose the total of the amounts promised and a description and amount for each group of promises having similar characteristics. And in order to determine that, we'll consider the key attributes of barriers such as barriers that are subject to matching, barriers that require incurring qualifying expenses, and those that have measurable performance-related barriers. We can look at those as the three types, of barriers. The effective dates, let's just say they're all in effect at this point. Even for the latest ones, for resource providers, if you look at the last bullet, annual periods beginning after December 15, 2019, so that would have been calendar year 2020, fiscal years ending in 2021. For recipients, it was a year earlier. We can apply this ASU on a modified prospective basis. The modified prospective basis would require no cumulative effect adjustment to opening net assets no restatement of prior period results, but there could be a retrospective application to each period presented in the financial statements. My recommendation obviously would be the modified prospective basis. It would be simpler. Okay, let's turn our attention to the other major standard that's been around for several years, leases. This one first came out early in 2016. The effective dates, again, there was a dichotomy between public and non-public entities, and again, it defined public non-profits are those with publicly traded debt, either direct or conduit. Once again, ASU 2020-05, because of the pandemic, provided a one-year deferral. For public nonprofits that have not yet issued their financial statements as of June 3rd, 2020, when this ASU came out, for public nonprofits, the one-year deferral took us to years beginning after December 15, 2019, which would be calendar year 2020, fiscal years ending in 2021. So that's becoming effective. For non-public nonprofits, notice 2 years later, years beginning after December 15, 2021. So for most nonprofits, the lease standard will become effective calendar year 2022, fiscal years ending in 2023. Early adoption obviously is permitted. So we've still got a year to go, but it's coming on us pretty quickly. The lease standard does not include leases of inventory, intangible assets, and assets under construction. They have their own topics in the codification. A lease was defined as a contract, but it's not subject to the RevRec standard. It has its own standard. A lease is a contract that conveys the right to use an asset for a period of time in exchange for consideration. Now, that means that there has to be an asset identified. It could be explicitly stated or implicitly specified in the contract. And the supplier of the asset has no practical ability to substitute and would not economically benefit from substituting the asset. Also, the lessee must have the right to control the use of the asset during the lease term, which means that the lessee has decision-making authority over the use of the asset, and the lessee has the ability to obtain substantially all the economic benefits from the use of the asset. The standard requires entities that lease assets with lease terms of more than 12 months to recognize a right-of-use asset and a lease liability measured at the present value of the lease payments. That means that on day one of the lease, we would book an entry, somehow debiting an asset, let's call it right-of-use asset for the moment, and crediting a lease liability. And that would be calculated at the present value of what the lease contract calls for to be paid. We'll also capitalize any initial direct costs, that is, incremental costs that an entity would not have incurred if the lease had not been executed. And the classic example there would be a broker's commission. However, costs to negotiate a lease will be expensed as incurred, such as legal fees. So if we're going to discount something to present value, what discount rate should we use? The standard requires the rate implicit in the lease, but only if readily determinable. If it's not determinable, then we can use the lessee's incremental borrowing rate. But good news for nonprofits. All organizations other than public business entities, and that means all nonprofits, because a nonprofit can never be a PBE. You can have public nonprofits if they issue or a conduit debt obliges on public debt, but that doesn't make them a PBE. So all nonprofits may elect to use a risk-free rate to measure lease liabilities. That's what the standard says, but there's news coming up later on that may change. That's what it is right now. So at initial measurement for that first debit and credit, the lease liability will equal the present value of the lease payments. The right-of-use asset will be equal to the lease liability plus, if applicable, any prepaid lease payments, plus, if applicable, any initial direct costs like broker's commission, minus lease incentives. We'll talk about it. We'll give you an example of that. Here's your second keyword, financial. Write it down, financial. Here's an example. So let's say we have a 5-year lease. Payments in the 5 years, starting at $5,000, increasing incrementally to $6,000. Our total lease payments are $27,000. To simplify this, there's no renewal option. We do have initial direct costs of $500. Let's say we paid a broker's commission. And we received a cash incentive to sign this lease from the landlord of $2,000. So here would be the initial entry. Since our total lease payments are $27,000, the lease liability would equal the present value of that $27,000 over 5 years, using a risk-free rate of that would be $24,900. Remember, we paid initial direct cost to a broker of $500, and we received cash incentive of $2,000 from the landlord. Here's that journal entry to recognize the lease. We're going to start with the credits. We're going to credit lease payable of $24,900. That's the present value of the lease payments. We're going to credit cash for $500. That's the amount we paid the broker. We're going to debit cash for $2,000 because we received a check from the landlord, an incentive to sign the lease. And therefore, the remaining debit to right of use asset is $23,400. So again, I'm just going to go back. That's what it is. Lease liability, present value of lease payments, right of use asset is the lease liability, plus prepaid lease payments, plus initial direct costs, minus lease incentives. And that's all we're doing here. Once we book the original entry, then we have to talk about recognizing expense as we move forward through the lease term. There are two types of leases, finance lease and an operating lease. Under the old lease standard, which I believe was FASB Statement 13, there were two types of leases, operating lease and capital lease. But it was so called because only capital leases went on the balance sheet. Now all leases go on the balance sheet. All leases more than 12 months go on the balance sheet. So we don't want to use the word capital, so they've changed it to finance lease. So what is a finance lease? A finance lease can be one of the 5 on the screen here. A lease that is effectively an installment purchase. That is, there'll be a transfer of ownership at the end of the lease term. That makes it a finance lease. Or the lease grants an option to purchase the asset, and it's reasonably certain that that option is going to be exercised based on the economics. Or the lease term is for a major part of the remaining economic life of the asset. Or the present value of the lease payments plus the residual value of the asset at the end of the lease term equals or exceeds substantially all of the asset's fair value. Or, and this is going to be less common, the underlying asset is specialized with no alternative use to the lessor after the lease term. If it meets any one of these 5, that lease is a finance lease. If it doesn't meet the requirements for a finance lease, it's classified as an operating lease. Now, why do we need to know? Because if we classify something as an operating lease, on the statement of activities, we will recognize a single total lease expense, we'll call it rent, calculated so that the cost of the lease is allocated over the lease term on a straight line basis. If it's a finance lease on the statement of activities, we will recognize the amortization of the right of use asset separately from the interest expense on the lease liability. This will result in a front loading of interest expense similar to a level debt service mortgage payable. For those of you who own a home and pay a mortgage, you pay the same amount every month. And on payment number 1, it's almost all interest and a little bit of principal. And then every month after that, it becomes a little less interest and a little more principal. That's called front loading of interest expense. If it's an operating lease on the statement of cash flows, we'll have one line, cash paid for leases, which will be an operating cash outflow. If it's a finance lease on the statement of cash flows, we'll have 2 lines. Cash paid for principal, which will be a financing cash outflow, and cash paid for interest, which will be an operating cash outflow. As far as subsequent accounting, for an operating lease, we will unwind the liability using the effective interest method. We'll straight line the expense over the term of the lease, and we will reduce the right-of-use asset by the difference between the annual straight-line lease expense and the annual interest on the lease liability. I'll give you an example of that in a moment. For a finance lease, we'll also unwind the liability using the effective interest method, but the interest will be determined on the lease liability in each period during the lease term using a constant discount rate, and the right-of-use asset will be amortized on a straight-line basis. So let's look at an example. So we have a 10-year lease with payments of $50,000 a year. We're considering this to be an operating lease because it doesn't meet the requirements for a finance lease. We're a nonprofit, so we're going to use a risk-free rate, and since it's a 10-year lease, we'll use the 10-year U.S. Treasury rate. Let's assume that's 3%. The present value of $500,000 for 10 years at 3% is $426,500, and that, by the way, is approximately correct. The fiscal year end is June 30, and the lease commencement date is July 1, 2021. So here are the examples, entries. The first entry on the first date of the lease becomes effective July 1, 2021. We're going to debit right-of-use asset, $426,500. That's the present value of the lease payments. And we're going to credit lease liability. There's no lease incentives here. There's no broker's commission, so it's a straight debit credit. And by the way, we do not have to call that asset right-of-use asset. If we're leasing a building, we can call it building. If we're leasing equipment, we can call it equipment. So that's the opening entry. It's pretty much the same as what we saw in the previous example, except there are no adjustments. In future periods, as we pay rent, remember rent is paid $50,000 a year. We're going to debit lease expense and credit cash for $50,000 every year. At the end of the first fiscal year, June 30, 2022, we're now going to book an entry where we're going to debit the lease liability, and we're going to use the same discount rate, 3%, and we're going to credit the right-of-use asset, which might be building, might be equipment, for $37,205. And what is that? If you recall, I'm going to go back a couple of slides. Look at the third sub-bullet here. We're going to reduce the right-of-use asset by the difference between the annual straight-line lease expense, which is $50,000, and the annual interest on the lease liability. So the calculation is very simple. We take the $50,000, which is the annual lease expense, and we subtract from that the balance of the the lease liability times the discount rate, which is 3%. And if you multiply $426,500 by 3%, subtract that result from $50,000, you get $37,205. This amount will increase each year from years 2 through 10, because next year, in the same calculation, it'll be 50,000 minus, and it'll be 389,295, which is 426,500 minus the 37,205. So every year, the amount in parenthesis will go down, and therefore the amount of the entry will go up. And if you do it right, by the end of the 10th year, the right-of-use asset will be fully amortized. The standard provides guidance as to the lease term. It says renewal options will be included in the lease term only if the lessee is reasonably certain to exercise the option based on current economic factors. Short-term leases with a term of 12 months or less, which do not have renewal options, are not required to be recognized on the balance sheet, and the standard does require several new qualitative and quantitative disclosures. Now, with respect to the lease term, if you sign a 10-year lease, you have an option to renew for another 10 years. The question, of course, becomes, do you have a 10-year lease or do you treat it as a 20-year lease? And the answer is it depends on whether you believe your organization, your client is going to renew based on today's economic factors. We'll apply the standard on a modified retrospective approach. At the beginning of the earliest year presented. Again, if we adopt it in 2022 and we present 2021 as comparative, in this we go back to the earliest year presented, and comparative periods, which would be 2021, would be in accordance with the new standard. Or we can do a cumulative effect adjustment to net assets at the beginning of the year of adoption, which will be 2022, And then for 2021, the comparative period is not required to be restated in accordance with the new standard. Again, my recommendation, of course, would be the modified retrospective approach. At adoption, you don't have to go back and reassess your leases. If you have things classified as capital leases, they just become finance leases. Operating obviously stays operating. When you prepare for implementation of this standard, which you should be starting to do, inventory your leases. Now, maybe you have one lease, you're leasing office space, period. Then the inventory is pretty small. But you could have many locations. You might be leasing office space, equipment, automobiles. So you have to inventory your leases. Review your capitalization policy. Make sure it's up to date. I mean, a capitalization policy of $500 today is kind of low. Even for small organizations, I wouldn't be capitalizing fixed assets lower than $5,000. So look at the leases, since you're going to be debiting, in essence, equipment or building or even right-of-use asset. It's still a long-term asset. It's property, plant, and equipment. Review your capitalization policy. Don't capitalize leases of equipment for under $5,000. It probably doesn't pay. Just expense it as you go along. Determine the effect on debt covenants. That's a biggie. You got to talk to your banks or lending institutions. Make sure they understand that booking that initial entry, at first entry, could create a violation of a debt covenant. A question was asked by many people at the time of adoption of this standard: when discounting the remaining lease payments, does an entity use the historical rate in effect at the commencement of each lease? Do you have to go back to the beginning date of each lease and figure out or find out what the discount rate was at that date? The answer is no. We have a practical expedient to use the discount rate in effect at the beginning of the year of implementation, including comparative years. So that's just something that will make life a little easier. Accounting by lessors remains unchanged for the most part. The AICPA did publish something for nonprofits, how to navigate the new lease accounting standard. And then, of course, the question is, what about donated space? It's not within the scope of the standard. But if you follow the contribution model in the codification, subtopic 958-605, you'll get your answer. And the answer pretty much is you're going to follow the lease standard, but for the most part, but the credit on the initial entry can't be lease payable. It has to be contribution revenue. I mentioned earlier the discount rate, and I said things are going to happen. There's a proposed ASU out, discount rate for lessees that are not public business entity, meaning all nonprofits. FASB is going to reconsider the risk-free discount rate accounting policy election available to lessees that are not PBEs, and that includes all nonprofits. What they're leaning to doing is retaining a risk-free rate for the discount rate policy decision rather than another specified rate such as the corporate bond rate or the prime rate. But then they're going to recommend that the risk-free rate election may be made by class of underlying asset. They'll require the lessee to disclose the election, including the asset class to which it has made the election. It will require the lessee to use the rate implicit in the lease when it is readily determinable instead of the risk-free rate or an incremental borrowing rate. That's the big change. The effective date and transition has not yet been determined. So this is still a proposal. You might want to get a look at it. Discount rate for lessees that are not PBEs. Because of COVID, many lessors are providing lease concessions to lessees, such as payment forgiveness and deferral of payments. Now, under GAAP, subsequent changes to lease payments that are not stipulated in the original lease contract are generally accounted for as lease modifications, but FASB issued a staff Q&A to address these COVID-19 related lease concessions. And here's what it says. Entities may elect to account for lease concessions related to COVID-19 as if the enforceable rights and obligations for those concessions existed in the original contract. So therefore, entities do not have to review contracts to see if rights and obligations for lease concessions exist. Entities do not have to, but may apply the lease modification accounting requirements, but they don't have to, which means they can go back to the first bullet on this slide and just account for them as if they existed in the original contract. Entities should provide disclosures about material concessions granted or received. So that's going to be a big help, and this is out already. This has been issued. It's a staff Q&A. Keyword number 3, revenue.
Hey, Alan,
Yes.
can we just pause on the keyword for about 30 seconds just to give the viewers just a little bit more time with the keyword so they can notate it?
Absolutely.
Thank you so much.
Not a problem. And because you gave me a moment, I was able to figure out what happened on my laptop, and I got the chat room back. All that happened is a window jumped in front of my my slides and chat room on the laptop. So we're back in business there. I have it, but there haven't been any questions yet.
There have not been any questions yet.
Okay. That means I'm either doing a fantastic job or I'm doing an awful job and no one understands anything I'm saying. So I'm going to hope it's the first one.
I think it's choice 1.
I hope so. All right, let's move ahead. So I'll give them 30 seconds each time.
Perfect.
All right, so we've now finished the 2 major standards that we wanted to discuss today, RevRec and grants and contracts, which is really part of it, and leases. But now let's go through a whole bunch of other standards. We're going to move a little more quickly. ASU 2016-13, measurement of credit losses on financial instruments. This one becomes effective for nonprofits. It will be effective in calendar year 2023 and fiscal years ending in 2024. So we've got a little while to go, but early adoption is permitted. It changes the financial accounting model applicable to all financial instruments other than those measured at fair value. So if you're already measuring a financial instrument at fair value, this standard does not apply to you. But the whole question on credit losses is why, and does it apply to nonprofits? The why was because of bank failures, due to loans going bad, due to mortgages, subprime mortgages, and other types of loans that banks were doing a number of years ago. But it does drag the nonprofits in because credit losses include losses on things such as student loans receivable, programmatic loans receivable, and trade receivables. And keep in mind that contributions receivable and grants receivable, if you're following the contribution model, is scoped out. Those are not credit. You're not giving someone credit if you have a contribution receivable. Yes, you are if you have a loan receivable or an account receivable. The impairment model is changing from an incurred loss model to an expected loss model, which means we're accelerating the recognition of a credit loss. And it requires an entity to measure all current expected credit losses, sometimes called CECL. You might have heard that acronym, CECL, and now you know what it stands for, current expected credit losses. Measure those over the contractual life of a financial asset. Current conditions and a broader range of reasonable supportable information are to be used to make credit loss estimates. And we're going to record the difference between the amortized cost and the amount to be collected as an allowance for credit losses, or an allowance for doubtful accounts, if you want to call it that. Now, here's the issue. Most not-for-profit entities have been doing it this way for years when it comes to loans receivable and other types of receivables other than contributions receivable. So I do not anticipate a material impact on most nonprofits when they implement this standard. Goodwill and intangible assets. The first one, 2019-06, extended the option from ASU 2014-02, which applied to private companies. It extends it to nonprofits. You might recall the Private Company Council, the PCC, has the ability to make recommendations for modifications to US GAAP applicable to private companies. And if it ultimately is passed by FASB and comes out as an ASU, FASB will then determine whether that modification to U.S. GAAP should apply to not-for-profits. And that's all 2019-06 does. It extends the options from 2014-02 to nonprofits. It has an open-ended effective date and a one-time ability to elect without having to demonstrate preferability, meaning that you can adopt this standard whenever you wish, whenever it applies, and even if it's after the effective date, you do not have to demonstrate the preferability of the standard, which is normally required if you adopt the standard later than the effective date. Here's what it says. A nonprofit that elects these accounting alternatives would do the following. Amortize goodwill over 10 years or less if appropriate on a straight line basis. There's an exception if the goodwill has real value in perpetuity. Test for impairment of the goodwill when a triggering event occurs that indicates that the fair value of the entity may be below its carrying amount. Notice, no requirement to test for impairment annually. That's the big thing. We don't have to do that anymore. Have the option to test for impairment at the entity level or the reporting unit level. So if we don't want to worry about reporting unit level, which I've never felt applies to nonprofits, we now have a reason to do that. And have the option to subsume goodwill into goodwill, certain customer-related intangible assets, and all non-compete agreements. So all this is doing, frankly, the important ones, if you even have goodwill on your balance sheet, the big ones are the first two. Instead of testing goodwill annually, you can amortize it over 10 years, but you still have to test when a triggering event occurs. However, ASU 2021-03, which obviously came out just a few months ago, accounting alternatives for evaluating triggering events. This one provides private companies and not-for-profits with an accounting alternative to perform the goodwill impairment triggering event evaluation and any resulting test for goodwill impairment as of the end of the reporting period. And the reporting period could be an annual period or an interim period. Only at the end of the reporting period. We do not have to monitor for goodwill impairment triggering events during the reporting period. This one will be effective on a prospective basis, beginning with calendar year 2020, fiscal years ending in 2021, which means now. Early adoption is permitted. Again, just as in the previous standard, there's an unconditional one-time option to adopt after the effective date without assessing preferability. So that one is out already. So it gives you, if you want to elect it, and you do have goodwill, and you want to elect the previous one, which allows you to test for impairment when a trigger event occurs, this will tell you only have to do it at the end of the reporting period, not during the period. Also, keep in mind, FASB has a current project to revise the subsequent accounting for goodwill and identifiable intangible assets for all entities. The objectives are to improve decision usefulness and to rebalance the cost benefit. So keep an eye on that. It might impact, or I would probably will impact on nonprofits. 2019-03 updated the definition of collections. Remember, a collection would be things such as works of art, historical treasures, or similar assets. It applies to all entities that have it, including business entities. It became effective calendar year 2020, fiscal years ending in 2021, which is now. Should be applied on a prospective basis. It modifies the definition of collections in the Codification Master Glossary to align it with the definition of collections used by the American Alliance of Museums, which allows the proceeds from sales of collection items to be used not only to acquire new collection items, which has always been the definition, but now it can also be used to support the direct care of existing collections. Remember, in order to have something called a collection and not be, and you can opt not to capitalize and depreciate it, you have to meet the requirements, one of which was how to use the proceeds from sales. So now this gives us an expanded use of the proceeds from sales. It requires an entity to disclose its policy for the use of proceeds from the sale of collection items. If an entity has a policy that allows proceeds from the sale of collection items to be used for direct care, it should disclose its definition of direct care because the codification does not define it. Then the AICPA issued a technical Q&A to provide non-authoritative guidance related to direct care of collection items. And it states that when an entity determines which costs are considered direct care, you have to consider some characteristics, and they give you some examples of them, whether those costs enhance the life, usefulness, or quality of the collection, whether it provides a benefit to the collections, and whether it excludes expenditures that are regular and ongoing in maintenance, such as routine maintenance of the collection, such as dusting. I mean, that's routine maintenance. That's not direct care. Gifts in kind was issued about a year ago. This one becomes effective for fiscal years beginning after June 5th, 2021, June 15th. Early adoption is permitted. It requires retrospective application to all periods presented. This standard improves the transparency in the reporting by nonprofits of contributed non-financial assets, such as we call those gifts in kind, or GICs. This is a presentation and disclosure standard. It does not change the existing recognition and measurement requirements. It does not address valuation. It's purely presentation and disclosure. Gifts in kind include fixed assets, such as land, buildings, and equipment, the use of fixed assets or utilities, materials or supplies, such as food, clothing, and pharmaceuticals, intangible assets, services, donated services, and unconditional promises of those assets. It requires nonprofits to present contributed non-financial assets as a separate line item in the statement of activities, apart from contributions of cash or other financial assets. It'll look like this on the statement of activities. Under contributions, you'll have cash and other financial assets, and then you'll have a line called in kind or non-financial assets. This line could be presented in a separate column, and I don't really like the way that would look. I don't think it's necessary, but it certainly is an option you can elect. There is no requirement to separately report the related expenses. Keyword number 4, annual. So mark down the word annual. Give me a moment to look to see if there are any questions. No questions. Okay, let's move ahead. There's a required quantitative disclosure.
Alan, can you go back to that keyword for just a few more seconds? Sorry, thank you. Annual, keyword number 4, annual. It's a blue screen keyword, everybody.
Okay.
Thank you.
Okie dokie. As far as disclosures, there's a required quantitative disclosure. Contributed non-financial assets recognized on the statement of activities should be disaggregated by category that depicts the type of contributed non-financial assets. And we went through some of those before. You recall at the top here, buildings, equipment, use of fixed assets, materials such as food, clothing, pharmaceuticals, et cetera, et cetera. That's what they're talking about there. There are required qualitative disclosures. For each category that we've disclosed on the quantitative disclosure, we have to disclose information about whether contributed non-financial assets were either monetized, meaning sold, were either monetized or utilized during the reporting period, and if utilized, a description of the programs or other activities in which those assets were used. In addition, we should disclose the nonprofit's policy, if they have one, about monetizing rather than utilizing contributed non-financial assets, a description of any donor-imposed restrictions associated with the contributed non-financial assets, the valuation techniques and inputs used to arrive at a fair value measure at initial recognition, and lastly, and this will be less common, the principal market or most advantageous market, those are technical terms of art from the fair value standard, used to arrive at a fair value measure if it is a market in which the recipient nonprofit is prohibited by a donor-imposed restriction from selling or using the contributed non-financial assets. As I said before, that's not going to be a common occurrence. You might recall when ASU 2016-14 came out, Presentation of Financial Limits of Not-for-Profit Entities. Well, at that time, there's something in there that has been missed by a lot of nonprofits and practitioners. And it has to do with equity transfers. Previously, before 2016-14, this applied only to not-for-profit business-oriented healthcare entities. But 2016-14 made it applicable to all not-for-profits. And here's what it says. The increase in net assets associated with services received from personnel of an affiliate for which the affiliate does not charge the recipient not-for-profit should be reported as an equity transfer. All nonprofits, not just business-oriented healthcare entities. Before the change in ASU 2014-16, the nonprofit that received donated services from an affiliate was recording the credit as a contribution revenue. Now, it says the credit should be recorded as an equity transfer, which should be reported separately as a change in net assets after a subtotal, such as change in net assets before equity transfer. The debit side of the entry would continue to be reported as an expense, such as salaries, which would be functionalized, or it could be reported as an asset. So that's a little glitchy change that's been missed by a lot of people. FASB's been looking at a lot of other things lately. They took consolidation of a not-for-profit by a for-profit sponsor. They removed that project from their agenda. They've also received feedback by the Nonprofit Advisory Committee, and they got this from not-for-profit stakeholders. They want to see a definition of an intermediate measure of operations. They want to see improvement in the not-for-profit consolidations model. They want targeted improvements to accounting for government grants, additional guidance on the valuation of non-financial assets, and additional guidance on management discussion and analysis for not-for-profits. So these are things that FASB might be looking at as we move forward. Okay, Paycheck Protection Program loans under COVID-19. There's an issue about revenue recognition. The AICPA issued a technical Q&A, borrower accounting for a forgivable loan received under the Small Business Administration Paycheck Protection Program. There are two approaches, a loan model and a contribution model, conditional contribution model. Here's what it says. Whether the nonprofit expects to repay the loan or expects it to be forgiven, either way, the nonprofit may account for the loan as a financial liability in accordance with Codification Topic 470, which is debt, and that will require it to accrue interest on the liability, and if and when the liability is forgiven, the nonprofit will recognize a gain on extinguishment, debt accounting. However, if the nonprofit chooses not to follow ASC 470 and expects to meet the PPP's eligibility criteria for loan forgiveness and conclude that the loan represents in substance a grant, it should account for the loan under ASC 958-605 as a conditional contribution. If so, then the cash inflow at the time they receive the loan proceeds would be treated as a refundable advance, debit, cash, credit, refundable advance. If you don't like that term, use something else, but don't call it a loan payable if you're treating it as a conditional contribution. A contribution would then be recognized once the conditions of release have been substantially met or explicitly waived. Now, I will tell you that every nonprofit that I've spoken with and every practitioner that audits nonprofits have told me their clients are recognizing these as conditional contributions, not as debt, not as loan payable. But that creates an issue. What are the barriers that need to be overcome? Remember, conditional contribution means there are barriers. Is meeting the condition for forgiveness the barrier? or is receiving the actual forgiveness the barrier? And there's no definitive answer. It's going to be based on judgment. The standard barriers in the PPP program are incurring qualifying expenses, for example, payroll, rent, mortgage interest, utilities, and maintaining or restoring headcount and salary levels. But there's nothing definitive about whether the third barrier is meeting the condition for forgiveness or actually receiving the forgiveness from the Small Business Administration. So the question is the review or forgiveness process a separate barrier to entitlement? And the answer is, does the entity believe that the act of forgiveness is administrative in nature or in furtherance of the program? And what is the program? The PPP program is keeping the entity in business. So it's going to be a decision made by each individual entity. Again, my discussions with practitioners, they're telling me that they are recommending to their clients that the client not recognize the contribution revenue until they receive the forgiveness. That's the recommendation that most practitioners have told me they're going to follow. Entities with material PPP loans should disclose their accounting policy for such loans and the impact on the financial statements. There's also the employee retention credit. There's a revenue recognition question on this. Credits are obtained as reductions of payroll tax, if you recall. These should be treated as grants and be recorded as grant revenue and a reduction of payroll tax liability, not a reduction of payroll tax expense. So the entry would be to debit payroll tax liability and credit grant revenue, not to credit payroll tax expense. All right, let's turn our attention to some auditing changes. We're going to talk very briefly about SAS 134 because we're going to take a deeper dive at the end of the morning. SAS 134 is the new audit report. It becomes the original effective date was going to be calendar year 2020 and fiscal years ending in 2021 with early implementation not permitted because of the pandemic. SAS 141 delayed the effective dates of SAS's 134 to 140 by 1 year. So now it's going to be calendar year ends 2021 and fiscal year ends in 2022. However, early implementation is no longer precluded. The Auditing Standards Board recommends that no matter what you do, whichever effective date you choose, the original effective date or the 1 year deferred effective date, implement SAS's 134 to 140 concurrently because there are a lot of interrelationships among them. SAS 135 was an omnibus statement intended to more closely align the Auditing Standards Board standards with the PCAOB standards. It amends a lot of AUC sections, including 240, consideration of fraud, 260, communication with those charged with governance, and 550, related parties. 136 deals with employee benefit plans. It creates a new AU Section 703. It creates new reporting requirements and performance requirements for audits of ERISA financial statements. That's the Employee Retirement Income Security Act. It changes the term ERISA limited scope audits. We've been permitted to do these limited scope audits for many, many years. And if you recall, if you have any clients which you do limited scope audits, or if you're with an organization that has limited scope audits, it means that the auditor is not doing any testing of investments other than confirming existence, and they're not doing any testing of investment revenue. And since that's the great bulk of the activity and the great bulk of the assets in an ERISA pension or benefit plan, it really doesn't amount to much, frankly. But never liked the term ERISA limited scope audit, so it's changing it to ERISA section 103A3C audits. And the reason is that's the section in the law that permits this to be done. This is not the AICPA saying, okay, auditors can do these audits, which doesn't include audits of investments and investment revenue. It's in the law. So that's why it's permitted. So they've changed the name to conform with the law. They've changed the form and content of the auditor's report on employee benefit plans to be consistent with SAS number 134, which we'll discuss later. It made changes to the ERISA section 103A3C report. There'll be a new section in the report. And it also includes new requirements to perform an ERISA section 103A3C audit. It has new requirements for communications with those charged with governance. And here's an interesting one. It says that management should provide the auditor with a draft Form 5500 that is substantially complete prior to dating the auditor's report. So that's a big change. SAS 137 talks about the auditor's responsibility related to other information included in annual reports. Now, this has been around for years, but 137 clarifies that the auditor's responsibilities relating to financial and non-financial information in documents containing audited financial statements on the auditor's report. So it basically says that the auditor has to read these annual reports. The auditor's opinion on the financial statements does not cover the other information. Before we move on, here's keyword number 5, implementation. Now I'll give everybody 30 seconds to copy down the word, implementation, keyword number 5. Okay, everybody should have written down implementation as the keyword number 5, so let's continue, but I want to go back for a moment. Nonprofits sometimes put out annual reports. Think of this glossy little booklet that they put out every year. It contains the financial statements and the auditor's report. It might contain letters from the CEO and from the chair of the board and maybe the development officer, talking about all the great things they're doing in the community, what their accomplishments have been in the last year, and also maybe asking for more contributions. But this is what an annual report is. It's not just a letter typed and sent out to people. It's an annual report, and it contains the financial statements. The standard clarifies that the auditor is required to read and consider other information in an annual report, which may indicate material inconsistencies with the financial statements. The auditor should remain alert for indications of a material misstatement of facts, a material inconsistency with the auditor's knowledge from the audit, or information that is otherwise misleading. It clarifies the scope of documents that the auditor is required to subject to these procedures. In other words, what constitutes an annual report. It requires the auditor, through discussion with management, to determine and obtain management's written acknowledgement regarding which documents comprise the annual report. And it requires the auditor to include a separate section in the auditor's report with the heading Other Information. This is only if they find something that's inconsistent in the annual report. I'm assuming that you will be looking at the annual report before it goes to press, you meaning the auditor, and you will be able to determine whether there are any of these misstatements or inconsistencies or misleading information. SAS 138 and Statement on Standards for Attestation Engagements number 20 both have the same title, Amendments to the Description of the Concept of Materiality. These standards align the Auditing Standards Board's definition of materiality for audits and for attestation engagements with the FASB, the PCAOB, the SEC, and the U.S. judicial system. In the past, the definition of materiality in the audit standards conformed to the international standard setters, the International Accounting Standards Board and the International Audit and Assurance Standards Board. And here's what it will now read. Misstatements, including omissions, are considered to be material if there is substantial likelihood that, individually or in the aggregate, they would influence the judgment of a reasonable user made based on the financial statements. Just some wording changes. The real big change here, if you look at it, is the addition of the phrase substantial likelihood and the elimination of could reasonably be expected. And the addition of the word would. Those are the, other than that, it's just wordsmithing. Okay, SAS 140. This one amended a number of AUC sections. The important one I want to talk about is AUC section 935, which is compliance audits. SAS 140 conforms section 935 to SAS 134, which is the new audit report, and provides an illustrative combined report on compliance and internal control over compliance. Now, the original and delayed effective dates and the early implementation of this SAS is the same as what we saw several slides ago for SAS 134. Originally, it would have been calendar year 2020, fiscal years ending in 2021. It's been delayed and deferred for 1 year, calendar year 2021, which is upcoming, fiscal years ending in 2022. And that's the same for all the SASs we just looked at, SAS 134 all the way up through 140. In addition to conforming the report to SAS 134, the report on compliance, SAS 140 does the following. It revises the definition of material non-compliance to align with the description of materiality in SAS 138. And remember, I said before, FASB, whenever you adopt it, they want you to adopt all of these standards, 134 to 140, at the same time. The reason being there are interrelationships among the standards. And this is just one clear example of it. SAS 140 referring back to SAS 138. It presents requirements for a combined report on compliance and internal control over compliance as the default form of report, followed by requirements addressing when the auditor chooses to issue separate reports on compliance and internal control over compliance. Now, I know that when I was in practice in my firm, we always used a combined report on compliance and internal control over compliance. I really don't know of anyone that issued separate reports on the two of those. Now it's basically saying that is the default form of report. The standard also updates references to OMB Circular A133 to instead refer to uniform guidance, and addresses changes in the OMB compliance supplement and the most recently issued Yellow Book, which became effective this past year. It also updates the Appendix AUC sections that are not applicable to compliance audits. There are a number of AUC sections, not many, but there are some that are not applicable to compliance audits, and that was in an appendix of a previous standard. Now it's in 140. There are a couple of other audit standards that have recently been issued. I just want you to be aware of. They're not in effect yet. 142 audit evidence becomes effective in calendar year 2023. It addresses the evolving nature of audit services. It talks about the accuracy, completeness, relevance, and reliability of audit evidence, the expanding sources of audit evidence, the innovative ways of gathering audit evidence, and it includes some discussion of when the auditor is working remotely, whether the information corroborates or contradicts management's assertions, and how to apply professional skepticism to the obtaining of audit evidence. 143 is auditing accounting estimates and related disclosures. This one will not become effective until calendar year 2024. It addresses the auditor's responsibilities relating to accounting estimates, including fair value. It enhances the auditor's focus on factors driving estimation uncertainty and potential management bias. And it encourages auditors to exercise professional skepticism when auditing accounting estimates. And we now come to the last topic in this session, attestation engagements. There were three that I want to talk about. Statement on standards for attestation engagements number 19, which deals with agreed upon procedures engagements. This one will become effective for reports dated on or after July 15th, 2021. So we've passed that date, so it's now in effect. Although early implementation was permitted, it's too late to early implement. Remember, this one talks about agreed upon procedures engagements, which is one type of attestation engagement. It provides practitioners with flexibility, does several things. It removes the requirement that the practitioner request an assertion from the responsible body. That's always been required, no longer. It allows procedures to be developed over the course of the engagement. In the past, that had to be developed prior to the engagement commencing. It allows the practitioner to develop or assist in developing the procedures, which was never permitted in the past. It requires the engaging party to acknowledge the appropriateness of the procedures before the issuance of the practitioner's report, not at the commencement of the engagement. And it permits the practitioner to issue a general use report, not just a restricted use report. All five of these provide practitioners with some element of flexibility in the engagement. But remember, that's dealing with agreed upon procedures engagements, say 19. Say 21, we discussed say 20, that dealt with materiality. We discussed it along with SASTA 138. So we covered 20. Say 21 deals with direct examination engagements. This is a new type of engagement. This will become effective for reports dated on or after June 15th, 2022. It adds a new ATC section 206 called direct examination engagements. It enables entities that do not provide an assertion about whether the underlying subject matter is in accordance with the criteria to undergo an examination engagement. That's never been permitted before. To do an examination engagement under the attestation standards, we always needed the entity to provide an assertion that the underlying subject matter is in accordance with the criteria that we're examining. Now it's no longer required. It does establish performance requirements for a direct examination. It changes the title of ATC Section 205 from examination engagements to assertion-based examination engagements. And that will differentiate Section 205, which are assertion-based, from Section 206. That's the new one. That's the direct examination engagement. So now there would be two types of examination engagements. Section 205 dealing with assertions by management. Section 206 if there is no assertion by management. It also substantially retains the traditional examination engagement, including the requirement for the practitioner to request a written assertion from the responsible party. And the last say I want to talk about is 22 review engagements, also becoming effective for reports dated on or after June 15, 2022, with early implementation permitted. Remember, this is a review under the attestation standards. It is not a review of financial statements under the SAR, Statement of Standards for Accounting and Review Services. This is an attestation engagement called a review. Don't confuse the two. It describes the types of procedures a practitioner may perform in a review engagement. It clarifies that the objective of a review engagement is to obtain limited assurance instead of being an exercise in performing analytical procedures and inquiries. It requires the practitioner to disclose in the review report the procedures performed to obtain limited assurance. And it also allows the practitioner to issue a report containing an adverse review conclusion when the subject matter is materially and pervasively misstated. Okay. I'm looking in the chat room. I do not see any questions that have come through. It is now 10 after 10 or 11 after 10, depending on which watch or clock you're looking at. Either way, we're concluded with our first topic, the nonprofit accounting and auditing update. We will now take a 10-minute break, and we will recommence at 10:20, and we'll discuss a single audit update. See you in 10 minutes. Jen, are you there?
Yes, Alan.
Okay, everything's going all right? From a
Yep,
technical
everything's good.
standpoint?
Yeah, everything looks great. Thank you. Thanks for slowing down on the keywords just a little bit.
Okay.
It just gives everyone an extra few minutes just in case, they're blowing their nose or grabbing a coffee or something just to get that attention of writing the word down. So
Okay. Not
thank you for the
a problem.
extra time.
When I reach number 7 and the second number 7, I will skip it.
Yes, please.
Not a problem. All right, I'll be back in about 2-3 minutes.
Okay, thank you. Alan, during the break, we muted your mic. If you just want to unmute when you're ready to go.
Jen, I don't know what to do here.
One of your devices, turn the sound off and keep the sound on for only one of them. Because I can hear you.
All right, well, what I have to do is, now, the problem is I have to turn off my laptop sound, but I can't find how to turn on my desktop sound because you muted me.
So on the device that your presentation is on, let's see if you can use the microphone that's on the Teams meeting. It should be somewhere near your chat box that you can see, either at the top or in the middle of your screen.
All right, now we're okay.
Perfect.
All right, you muted me and I didn't know that.
Sorry about that.
Because I've been saying, "Does anybody hear me? Can anybody hear me?" All right, we're gonna run late now because it's already 10:28, so.
That's okay.
Yep.
Yep, we can hear you now, and all good to go. Sorry about that.
Nah. Okay. Sorry for the delay. We had a technical glitch. So we're ready to do a single audit update. Now, until this year, I always included the single audit update as part of the A&A update that we just did, because it was basically 10, 12, 13, 15 slides. Now it's become its own 50-minute session. And in fact, it's a long 50-minute session to begin with. We've got something like 60 slides to go through. So we're going to do our best to finish it within a handful of minutes after the allotted time frame. But we can make up for that in the last session, which is the new audit report. Excuse me, audit report standards. So in this session, we're going to cover the 2020 compliance supplement, revisions to the uniform guidance, other activities related to the COVID-19 pandemic, both from the federal government and from the AICPA, other AICPA guidance that will impact on single audit performance, and we'll talk briefly about the 2018 Yellow Book, which became effective last year. So the 2020 compliance supplement was released in August of 2020. Now, I know you were sent slides. I'm not sure when it was sent to you, but I sent it to Freed Maxick approximately 2 weeks ago. Since then, things have happened in the world of single audit, so I have adjusted some of the slides. So what I have here are the updated slides. There are just a handful that have been changed. This happens to be one of them, and I believe it's just the first two bullets. The 2020 OMB compliance supplement was released in August of 2020. It is effective for audits of fiscal years beginning after June 30, 2019, which means you will use the 2020 OMB compliance supplement to do single audits for fiscal years ended June 30, 2020, December 31, 2020, and in fact, any years ending in 2021 prior to June 30, 2021. So if you have a March 31, 2021 fiscal year end, it would use the 2020 compliance supplement. This supplement does not address COVID-19 implications other than in Appendix 7, which is other audit advisories. We'll talk about that in a little while. Then OMB released an addendum in December of 2020, which addresses certain of the new federal programs established by the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act. All right, keyword number 6, grant. I'll give you 30 seconds or so to write that word down. Keyword number 6, grant. One more time, keyword number 6, grant. Okay, let's move on. The 2020 compliance supplement provides routine updates unrelated to COVID-19. Unrelated. It adds new programs and deletes some programs. It does that every year. It changes existing programs, including significant changes this year to the student financial assistance programs. There are approximately 60 programs in this supplement that had changes from the prior year. And so you understand it, that's about 30% of the total programs in the supplement. The 2020 supplement maintains the 6 requirement mandate that first came out in the 2019 supplement. Remember, federal agencies can require up to 6 of the compliance requirements to be audited. There's an exception. R&D may be identified as a 7th requirement. Also, activities allowed and unallowed and allowable cost principles, which are 2 compliance requirements, are treated as if they're 1 compliance requirement. So really the 6 requirement mandate could be as high as 8. Some programs have changes regarding the 6 requirements. And understand and remember that the 6 requirement mandate does not apply to programs that are not included in the supplement. Also a reminder regarding the 6 requirement mandate. For Part 2 Matrix Y entries, Y means subject to audit. Auditors must still determine whether those requirements could have a direct and material effect on their particular client's program. And if an auditor determines that a Y requirement will not be tested as part of the compliance audit because it does not have a direct and material effect, the auditor must document the rationale for not testing. And NA is not an appropriate way to document why a requirement subject to audit is not going to be tested. Part 2, the matrix of compliance requirements, identifies the requirements that have changed by identifying them in bold and yellow highlighting. So that's a good improvement. The 2020 supplement removes Part 3.1, used previously for federal awards made prior to December 26, 2014. So now there's only one Part 3 called compliance requirements. If your auditee is still expending federal funds from awards received prior to December 26, 2014. That was the effective date of the uniform guidance. Use Part 3.1 from the 2019 supplement because it's been eliminated from the 2020. The supplement updates Part 5 clusters of programs, and very important, Appendix 7, which is other audit advisories, provides that although the addendum, remember the addendum came out 4 months later after the original compliance supplement, so Appendix 7 of the supplement provides that although the addendum will include new COVID-19 related programs and changes to existing programs due to COVID-19 funding, the addendum will not add new clusters of programs, nor will it revise existing clusters. That became very important in audit planning, and in fact, the addendum complied with this. It did not add new clusters or revise existing clusters. There were no changes to Part 6, internal control. You recall Part 6 was totally refreshed in the 2019 compliance supplement. There were some minor changes to Part 7, guidance for auditing programs not included in this compliance supplement. And if you want to look at the changes, and this is applicable every year, if you want to look at changes from the previous compliance supplement, you go first to Appendix 5. It will list all the changes from the previous compliance supplement. Then my recommendation, if you had read the previous compliance supplement, you only need to read the changes. You don't have to reread the whole compliance supplement. It also provides information on COVID-19 in Appendix 7, other audit advisories. And this is what it covers. I'm not going to run through all of these because we're actually going to pick up on a lot of them as we go through the rest of this presentation. But this is the areas covered in Appendix 7 with respect to COVID-19. The compliance supplement now is a requirement to identify COVID-19 expenditures on the CFA, Schedule of Expenditures of Federal Awards, and on the data collection form, that's the CFSAC. And here's an example of what it might look like on the CFA for TANF, Temporary Assistance for Needy Families. You have 3 lines. COVID-19 TANF with the CFDA number, 93558, $1 million. Temporarily Assistance for Needy Families, obviously non-COVID-19, $3 million, and then a total of $4 million. There is also a requirement now to add COVID-19 in the additional award column on the data collection form for existing programs with incremental COVID-19 funding. There is an issue regarding adding a new program to an existing cluster, and here's the question. When a new program is added to an existing cluster, can that cluster still meet the 2-year look back if the cluster was audited in the past 2 years? And the answer is, the cluster may still be considered low risk if the added program's expenditures are less than or equal to 25% of the Type A threshold. Now, that decision is still subject to a risk assessment. You still have to, if it's a Type A program, you have to do a risk assessment, and if you determine that it's high risk or technically not low risk, then it will be audited. But this at least gives us the ability, if we have a cluster that was audited in the past 2 years, and a new program was added to that cluster, and it's less than 25% of the Type A threshold, you can consider it low risk. The effective date of the addendum, which came out in December of 2020, is the same as the August 2020 supplement. That is, audits for fiscal years beginning after June 30, 2019. So once again, to remind you, that would be June 30, 2020 year ends, December 31, 2020 year ends, and any 2021 year ends prior to and not including June 30, 2021. The addendum must be used in conjunction with the August 2020 supplement in determining the appropriate audit procedures to support the compliance opinion. Part 1 of the addendum provides a description of which parts of the August 2020 supplement are being modified, as well as which sections are new. Part 2, the matrix, identifies the requirements subject to audit for all new programs, and it's noted with the word new after the title, and it's bolded, so you'll see it at a glance, as well as existing programs that are included in the addendum. Part 4, which are agency program requirements, contains both new COVID-19 programs and existing programs which have changed due to CARES Act funding added to the program. But keep in mind, there are other programs impacted by COVID-19 that are not included in the addendum. OMB was not able to, nor did they wish to get into every program impacted by COVID-19. But the big ones are in there. FFATA, the Federal Funding and Accountability Transparency Act, requires direct recipients who make first-tier subawards of $25,000 or more to report subaward data through the FFATA subaward reporting system. Part 3 of the addendum requires the auditor to test FFATA reporting for all COVID-19 programs included in the addendum, except for the Coronavirus Relief Fund, more on the Coronavirus Relief Fund later, for fiscal years ending after September 30, 2020, regardless of whether COVID-19 funding is involved, if the compliance requirement is marked as a Y in the Part 2 matrix. We have, in the past, there's been a lot of confusion regarding when do we test FFATA reporting. This clarifies it. Part 5, clusters of programs, informs auditors that there may be requirements in the August 2020 supplement concerning the student financial assistance cluster that may have been waived or changed due to the pandemic. And it refers auditors to a website of student financial assistance related COVID-19 issues developed by the Department of Education. This only applies if you audit a client that has student financial assistance cluster. Appendix 7, this is still the addendum, other audit advisories, provides for a 3-month audit submission extension for single audits of 2020 year ends through September 30, 2020, only if the recipient expended COVID-19 funding reported on the CFA. For example, the single audit deadline for June 30, 2020 year ends is extended from March 31, 2021 to June 30, 2021. Well, at this point, that's passed. But if you have a September 30, 2020 year-end client, all right, that would have been due June 30, 2021. That's been extended to September 30, 2021. So we still have a month and a half before that comes to due. Auditees do not need to obtain approval for this extension. However, they must document the reason for the delayed filing. The reasons: COVID-19, loss of staff, working off-site, that kind of stuff. Auditee that files within the extension period will still qualify as a low-risk auditee, assuming it meets all the other requirements. So that's that. I just want to make a note of something. I want to change this slide and change the example from a June 30 year end to a September 30 year end so it stays current for at least another month and a half. But keep in mind, for this limited extension, which only carries through September 30, 2020 year ends, it's only if the recipient expended COVID-19 funding reported on the CFA. Appendix 7 states that non-federal entities that receive donated personal protective equipment, or PPE, should include the fair value of the PPE in a standalone note to the CFA that is marked unaudited. The donated PPE should not be counted for purposes of determining the single audit threshold or determining the Type A/B program threshold, and is not required to be audited as a major program. So how do we actually use the compliance supplement? So we start with Part 2. That's the matrix. If a federal program is included in the supplement, then you go to Part 4 for the specific requirements, and you go to Part 3 for the generic requirements and suggested audit procedures. If a federal program is not included in the supplement, and remember, not every COVID-19 program is in the supplement, then you go to the guidance in Part 7 and determine which of the 12 compliance requirements are applicable, and then you use Part 3 for the generic requirements and suggested audit procedures. Keyword number 7, contract. Number 7 is contract. I'm going to give you about 30 seconds to look at this and write it down. Keyword number 7 is contract. Okay, should have written it down. Let us now move ahead. This is a slide that has changed from what you might have in front of you if you look at the slides that I sent to Friedmax a couple of weeks ago. The 2021 OMB compliance supplement was released in August 2021, just last week. It is effective for audits of fiscal years beginning after June 30, 2020, which means fiscal years ended June 30, 2021 and December 31, 2021, and moving forward into fiscal years ended in 2022 prior to June 30, 2022. But the important thing is June 30 and December 31, 2021 year ends. OMB will be releasing 2 addenda to the 2021 supplement later this year, primarily to address new programs established by the American Rescue Plan. Now, you might have seen something in writing from OMB that stated that they will be releasing 1 addendum. We now know that it will probably be 2 addenda. When? Hard to say. My guess is one will be out in early fall, the other will be out in mid to late fall. Auditors should wait until the addenda are released for guidance necessary to complete major program testing. In other words, familiarize yourself with the 2021 compliance supplement, but don't start doing your June 30, 2021 audits yet. Wait until the addenda are released before you start to test major programs. OMB issued revisions to the uniform guidance. It's effective for new federal awards and modification of existing federal awards occurring on or after November 12, 2020. There are 3 exceptions to that effective date, but those are not worth discussing. They're not common. The revisions include 5 areas: changes to the procurement standards, expansion of the use of the de minimis indirect cost rate, timing of the single audit quality project, and we'll discuss each of these in the next few slides. And then also definition and terminology changes, a lot of those. And the goal is to align with statutory and other requirements. So we're not going to discuss those last 2 in detail, but we will talk about the first 3. And the first one are revisions to the procurement standards. The micro purchase threshold has been changed from $3,500 to, depending on how you fit in, up to $10,000, and you need to take no action there, just use that threshold. Or if you want to go higher, up to $50,000, you can qualify, but you must self-certify. If you want to go greater than $50,000, then you need cognizant agency approval. Most small and mid-sized nonprofits will be able to increase to $10,000 without having to take any action. The threshold is based on internal controls, the evaluation of risk, and documented procedures. We do need an explanation for determining the price that you use, and the non-competitive method does not apply to micro purchases. The simplified acquisition threshold was increased from $150,000 to $250,000, and this threshold is also based on internal controls, evaluation of risk, and documented procedures. The revisions to the UG expand the use of the 10% de minimis indirect cost rate to all non-federal entities that do not have a current, notice that's bold, a current negotiated indirect cost rate, including a provisional rate. It is an exception for state, local, and tribal governments. So it means that all nonprofits and IHEs, Institutes of Higher Education, can now expand the use of the 10% de minimis rate if they do not have a current negotiated indirect cost rate. You might recall that the UG originally provided that the 10% de minimis indirect cost rate could be used only by non-federal entities that never received a negotiated indirect cost rate. We had a lot of clients that had indirect cost rates, negotiated indirect cost rates back in the 1970s and 80s that haven't had it since then, and they could not use the 10% de minimis rate because of this. Now they may. It also clarifies that when a non-federal entity uses the de minimis rate for its federal awards, it is not required to provide proof of costs covered under that rate. And that was in a previous frequently asked question of the COFAR, which is the Council of Financial something of a Reform, Financial Accounting Reform. Council of Financial Accounting Reform, which is a quasi-governmental body. The third major change to the UG, it changes the date for the requirement for a government-wide audit quality project that must be performed once every 6 years to years beginning with audits submitted in 2021. The UG originally provided for this study of single audit quality to begin with audits submitted in 2018, but it never happened. OMB never did this. So now it's required to be done every 6 years. So it'll begin with audits submitted in 2021. So that could be June 30, 2020 and December 31, 2020 year-end audits. It clarifies that for purposes of the project, the federal government may rely on current and ongoing quality control review work performed by federal agencies, state auditors, and professional audit associations, which means that if your firm is selected to participate in this single audit quality study by the federal government, and you can show them that your latest peer review, if it was for audits in the right period, included a single audit or two, they may be able to rely on that to do their work. So that may be helpful. On February 22nd of this year, OMB issued a Federal Register notice entitled Guidance for Grants and Agreements. It contains several technical corrections to the previous UG revisions that we just discussed. It fixes citations and references and clarifies language, but it does not appear to have any substantive changes. OMB issues memorandums. The M stands for memorandum. The next two digits is the year. 20 means issued in 2020, followed by a number, a sequential number. So OMB memorandum M2026 states the following. Recipients must maintain appropriate records and cost documentation to substantiate charging salaries and other costs related to interruption of operations or services. It also clarifies that payroll and other costs paid with PPP loans or any other federal CARES Act programs must not be also charged to current federal awards, as it would result in the federal government paying for the same expenditures twice. That's called double dipping. It's illegal. So it's a clarification that if you get money from the PPP loan program and you pay certain expenses with those loan funds, do not charge those expenses to a current federal program. It also states, in order to provide adequate oversight of the COVID-19 Emergency Act's funding and programs, recipients must separately identify COVID-19 on the CFA and the data collection form even if it's additional funding to an existing CFDA number. So you have to separately identify. We had a slide earlier which showed how that looks for the TANF program on the CFA. Now, we talked about single audit extensions that went through 2020, September 30, 2020 year ends, but this memorandum actually came out prior to the addendum for the 2020 compliance supplement. So this memorandum provided single audit due date extensions to recipients and subrecipients affected by the loss of operational capacity due to the COVID-19 pandemic through December 31, 2019 year ends. So this came out first. It extended it through December 31, 2019 year ends, but this was only if you've been affected by the loss of operational capacity due to the COVID-19 pandemic. And if you recall, the other one was only for the expenditure of COVID, if you expended COVID funds. That took you through September 30, 2020 year ends. Hold on, we'll see what happens going forward. Okay. Then OMB came out with Memorandum M2120. This came out after the 2020 compliance supplement was issued. This one provides single audit due date extensions to recipients and subrecipients that have not yet filed their single audits with the Federal Audit Clearinghouse as of the date of the issuance of this memorandum, which was March 19, 2021, that have fiscal year ends through June 30, 2021, to 6 months beyond the normal due date. So now we've got extensions that carry us all the way through years ended June 30, 2021, and the extension is now 6 years beyond the normal due date. This extension applies to all entities who are required to undergo a single audit, regardless of whether they have COVID-19 funding. So this is a broader extension of due dates. And here's what it will look like. If you have a fiscal year end of June 30, 2020, the original due date was March 31, 2021. We're now extended through September 30, 2021. 6 months. If your fiscal year end is December 31, 2020, it was due originally September 30, 2021, now due March 31, 2022. For June 30, 2021 year ends, we're now extended all the way through to September 30, 2022. So certainly OMB is paying careful attention to the needs of auditors and auditees because of COVID-19. Remember, this extension applies, I'm going back a slide, regardless of whether you have COVID-19 funding. It applies to all entities who are required to undergo a single audit. It goes back as far as June 30, 2020 year ends and goes up to June 30, 2021 year ends. To get this extension, it does not require recipients and subrecipients to seek approval for the extension. Recipients and subrecipients should maintain documentation of the reason for the delayed filing. And again, working off-site, virtual working, loss of staff, whatever. There are a number of reasons all tied into the pandemic. Recipients and subrecipients taking advantage of this extension would still qualify as a low-risk auditee, assuming all other requirements are met. Let's take a look at some other federal COVID-19 activities. Now, Congress, you know, has made appropriations under several acts to address the COVID-19 pandemic. The one that has gotten the most attention, the largest one, is the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, which includes quite a number of fundings. The four big ones: the Paycheck Protection Program through SBA, which are loans to businesses and not-for-profits; the Provider Relief Fund, which comes out of the Department of Health and Human Services. These are payments to hospitals, nursing homes, and other healthcare providers. The Educational Stabilization Fund out of the Department of Education. These provide grants to states, local school districts, and institutions of higher education. And the Coronavirus Relief Fund out of the U.S. Treasury, which has payments to state, local, and tribal governments. So we're not concerned about that in the nonprofit sector, but we are with the first three. As the pandemic continues, Auditors should be alert to additional actions by Congress after the release date of the 2020 compliance supplement. Federal agencies, keep in mind, may have incorporated COVID-19 funding into an existing program and CFDA number, or set up a separate COVID-19 program with a unique CFDA number. And federal agencies are required to specifically identify COVID-19 awards, regardless of whether the funding is provided under a new or existing CFDA number. But I think what you need to keep in mind is that this is a moving target. The supplement comes out once a year, the addendum comes out once a year, but there are fundings after the fact. So you have to keep an eye on those. We're going to talk about that later on in this topic. When COVID-19 funds are subawarded from an existing program, the information furnished to subrecipients should distinguish the subawards of incremental COVID-19 funds from non-COVID-19 funds subawards under the existing program. So the pass-through entity has to do what the funding entity does, identify which are COVID-19 funds and which are not. I mentioned a few times already the CARES Act. The CARES Act and other legislation provided funding for new programs and additional funding for existing programs. The Paycheck Protection Program, or PPP, is the only program not subject to single audit, because it was determined that that is a loan from banks, not from the SBA. Although PPP may be issued a CFDA number, it is not included on the CFA. Keyword, we already dealt with keyword number 7. If remember, I may have mentioned before it's a typo. There were 2 keyword 7, so we can ignore this one, but I think we did 7 already. So we're going to ignore this one. I want to double check something. Just give me a moment. Yep, I'm right. So ignore that. Ignore key contract. All right. Some new COVID-19 programs. In order to assist recipients and auditors in the identification of all the COVID-19 funds and their related program CFDA numbers, OMB published a listing of the COVID-19 programs along with their CFDA numbers in a link under guidance, policies, and resources. So if you go, you can't really click on this link on the slide, but you can copy it and paste it and then get to it. It provides some good guidance on COVID-19 programs. If there is an asterisk by the CFDA number, once you get into this link, that denotes a new CFDA number. I mentioned the Provider Relief Fund earlier, and I said we'll get back to it, and here we are. And again, this one, I believe, is a changed slide from what you have, if you had the original slides that I sent to Fried Maxick. HHS released frequently asked questions stating that non-federal entities will include Provider Relief Fund expenditures and/or lost revenues in the CFA for fiscal years ending on or after June 30, 2021, as opposed to the previous guidance, which required that it would begin starting December 31, 2020. So PRF expenditures and lost revenues are excluded from the scope of single audits until fiscal years ending on or after June 30, 2021. So if you're still doing a December 30, 2020 single audit, you will not include Provider Relief Fund expenditures and lost revenues in the audit. The 2021 compliance supplement should recommend, and it actually does, delaying the start of the compliance audit of the PRF program until recipients have completed the PRF report, which is subject to compliance testing. I'm going to change that. Since I added the slide about the 2021 compliance supplement, I'm going to change should recommend to recommend, so I'll make that change afterward. Department of Health and Human Services determined that COVID-19 vaccines provided by the federal government to non-federal entities, including not-for-profits, are not considered federal financial assistance and should not be reported on the CFUND or included in the scope of a single audit. And the reason for that is DHHS determined that these are actually awards to the individuals receiving the vaccines. They're not, the nonprofits and other entities are just the administrators, they are administering the vaccine, not administrating it, but administering the vaccine. So these are not included in a single audit. And then there's the American Rescue Plan Act of 2021, which provides funding for both new and existing federal programs. The potential implications to single audits are not yet known. Federal agencies are currently establishing program policies about whether funds under ARPA will be subject to single audit. But we do know that nonprofits that receive shuttered venue operators grants will be subject to single audit. We'll get more information on the American Rescue Plan as we move forward in time. There's been a lot of confusion, amongst other things, as to when to report costs incurred or lost revenue, if applicable, on the CFA. This is due in part to the short time between passage of the CARES Act and receipt of funding by nonprofits, sometimes even before award terms and conditions were established. Also, it's because some programs allow costs to be charged both before and after the award was made. So you're allowed to charge costs that you've already incurred prior to getting the award. So the question becomes, well, which CFA does it go on? So there's been a lot of confusion about that. So in February of 2021, the AICPA Governmental Audit Quality Center, the GAQC, issued GAQC non-authoritative guidance on the reporting of certain COVID-19 awards on an accrual basis CFA. That will give you the guidance you need. This document is available on the GAQC website. I believe Fried Maxick is a member of the AICPA's GAQC, so you can get it. It provides illustrative scenarios to assist in determining which fiscal year to report costs incurred on an accrual basis CFA. Also, in February of 2021, the GAQC updated its GAQC Summary of Uniform Guidance Applicability for new COVID-19 related federal programs. This one is available also on the GAQC website. It provides guidance regarding the applicability of the UG, the Uniform Guidance, to specific federal programs, but it does not apply to single audits of the Provider Relief Fund. So with all this in mind, all the things we've discussed, this is going to create and has created a number of single audit challenges. Let's go through some of them. Since COVID-19 funds, since COVID-19 funds were released very quickly, many federal agencies have developed new audit requirements, and this has led to a lot of questions, uncertainty, as I just mentioned, and the result is going to be a lot of significant challenges for our 2020 single audits and our 2021 single audits. It's not going to necessarily abate for the second year. In fact, there'll be reasons for it to get more confusing. Documentation of key decisions by both auditees and auditors is more critical than ever. There will be more single audits than in previous years, for several reasons. Many states and large local governments receive significant amounts of COVID relief funds or coronavirus relief funds directly from the federal governments, and these recipients may have passed these funds down to smaller entities that may not have had single audits in prior years. And then there's other funding through the CARES Act to existing CFDA numbers that may take recipients over the threshold to have a single audit of $750,000. Clients may receive funding for new programs under the CARES Act, and these programs may have new compliance requirements. In fact, I'll tell you that they do have new compliance requirements. So we, the auditors, need to gain an understanding how the client is addressing the challenge of new CARES Act money covering expenses already incurred, which they may be permitted to charge. Consider whether audit work will need to be performed remotely due to COVID-19 restrictions, meaning that the client's building is closed or their office is closed, so we have to do our work remotely. I'm the chair of an audit committee of a local charity here in Rockland County, New York, Center for Safety and Change, a really great organization. It's a crime victims service organization dealing mostly with sexual harassment and abuse, spousal abuse, human trafficking, and other types of victims' crimes. But the point is, I chair the audit committee, and the December 2020 year-end single audit is still underway. Here we are in the middle of August. And it's predominantly due to the COVID-19 problems. New funding, state of New York not executing contracts. I'm sure you're experiencing that up in Buffalo also, a great delay in executing contracts, but also the audit firm is working remotely. Our staff is working remotely. It's creating a lot of significant but practical problems.
Alan?
Yes.
Valerie, one of our guest attendees, one of our clients, she'd like to see the GAQC info on the CIFA. Can it be shared if she doesn't have access to the AICP, the AICPA membership portal?
Now, if you're not a member of the GAQC, you can get some information. If you go into the AICPA site, there is a way you can get some GAQC. They do archive some of their the GAQC memoranda, and you can get at it. I have a direct link to it, so I can't tell you exactly where it is because I downloaded a link years ago and I don't remember how I did it. But I cannot get to most GAQC information. I'm not a member. I'm not a practitioner, I'm just a lecturer, so I don't see the benefit of paying that money. So the answer to it is there is no way that you can see most of the GAQC information. I'm not sure what you mean by love to see that GAQC info on the CIFA. They do, I think if you mean that the AICPA does publish some information about how to prepare the CIFA, if that's what you mean, again, most GAQC information is not available except to members of the GAQC. I know I lecture for the AICPA on single audits. I haven't since the pandemic started because a lot of the conferences have gone virtual and I just haven't had the inclination to do that. But I asked them as a lecturer for the AICPA, and you don't get paid for these things. Can't they give me gratis access to the GAQC website? No, not our policy. So that's it. Wait a minute. I meant the information that you mentioned about how to properly prepare an accrual basis CIFA. Ah, okay. I know what you mean now. You're talking about this. The GAQC non-authoritative guidance on the reporting of certain COVID-19. It's available on the GAQC website. I do not believe that you can get it that. Now,
Alan,
yeah.
It's Michelle Sullivan.
Hi, Michelle.
Hi, how are you?
Oh, I'm good.
Excellent. You're doing a great job.
Thanks.
A suggestion for the question, and it sounds like Jen had alluded to, it's a client. If the client wants to reach out to the partner or the manager on the engagement, we can see, because obviously our firm, Fried Maxick, is a member of the GAQC. So if there's something we can pull down and share that would be helpful to the client, we're happy to do that. So I would just suggest just reach out to the partner or the manager or the team member on the engagement, and we'll see what we can do to provide information that's helpful.
Thank you. I was going to say that, but I didn't think it was my place. Client can, oh, just call Freed Maxic and they'll get it for you. So
Right, yeah,
my
no,
mouth shut.
no problem at all.
You know,
Yes, I totally
you
understand.
don't
All
bite the
right,
mouth.
that's why I figure I would chime in. All right.
Right. Okay. Let's see, where was I? Determining whether a non-federal entity has funding under a new COVID-19 program or programs that are subject to single audit is important. We have to know where the funding is coming from and if it's COVID-19 or not. This becomes critical to both major program determination and AB threshold determination. New COVID-19 programs may be high-risk type A programs because they've not been audited before. Remember, any type A program that has not been audited before, even a first-year program, must be chosen, selected as a major program and audited in the year it first appears. New COVID-19 programs could also be type B. They could be below the threshold. In evaluating risk, we need to consider the newness of the programs. I always took the position when I was still in practice that a type B program, that it was a first year program, it was by definition high risk. That doesn't mean it needs to be chosen. Remember, you don't choose all type B high risk programs. All type A high risk you choose. Type B programs, it depends. Remember, there's a formula involved and you've got to meet the percentage of coverage requirement. There's currently no requirement to select these type B programs for audit in order to consider them high risk, but I always had a simple policy that I told the staff, if it's a first year program, it's by definition high risk. Doesn't mean we have to select it. But remember, a first year type A program must be high risk, must be selected. Type A programs that might have been low risk would be impacted by changes in personnel and systems due to COVID-19 funding or moving to a remote environment. Remember, when you do your type A risk assessment, you may not consider inherent risk. You may consider inherent risk in type B risk assessment, but not in type A. And there was a reason for that, going back in history, why they eliminated that, because a lot of what some audit firms were doing, if there was a program, a type A program that was audited in a previous year, that was clean as a whistle. The audit went fast, easy, no adjustments, no findings. They want to audit that again the next year and it wouldn't pass muster because it's low risk. Then they would say, well, it's high inherent risk. You can't do that. But you can consider inherent risk in the type B programs. Let's just see if there are any questions that have come up. No more. Okay. Auditors will need to identify whether the client's existing programs have compliance requirements subject to audit that have been revised. And one way you do this is to discuss this with clients. How are they identifying changed requirements? Don't get confused. It is the client's responsibility to identify compliance requirements. And if the client is not appropriately identifying compliance requirements, that should be a finding by the compliance auditor. But most clients are able to identify their compliance requirements. They have someone on staff whose responsibility is doing just that. But then discuss with clients how they are identifying changed requirements, because requirements are changing as we move forward through the COVID-19 pandemic time. Testing completeness of the CFA will be especially important this year. Recipients should separately present COVID-19 relief funds on the CFA. Remember, we have to separate COVID-19 from all other funds, even if it's in the same program like we saw before on the TANF. You'll have COVID-19 TANF, TANF, and total TANF. Issues may arise relating to client documentation, evidencing compliance due to COVID-19 shutdowns or operating changes. Remember, we have to talk about the reason. We have to disclose or document the reason for taking advantage of the option to delay the due dates or defer the due dates. We have to document why we're doing that. So there has to be some sort of documentation evidencing compliance due to COVID-19 shutdowns or loss of operational capacity. Pay special attention to internal controls over compliance. New awards, as well as a switch to a more work-from-home environment, may have introduced changes to clients' internal controls over their federal awards. We're going to touch on this and a lot of other things because of work-from-home environment when we talk tomorrow about the nonprofit audit risk alert for 2021. Make certain that findings include all the required elements, and it's more important this year than ever. First of all, we have potentially more findings this year due to COVID-19 funding. Remember, COVID-19 funding is brand new, and traditionally with new programs of any type, COVID-19 or anything in the past, there are more findings when programs are new because clients are not as up to date. They're not as experienced. It's new to the staff. So there are going to be possibly control issues. There are going to be compliance findings and more findings now due to the COVID-19 funding, especially because of changes in the requirements. I mean, think of the PPP. Well, PPP is not subject to single audit, but think how frequently the requirements under PPP have changed. Federal agencies are also more likely to follow up on COVID-19 findings. At least we hope they will. Also, make certain that you do test for double dipping. Be careful, look for costs that have been paid for Federal CARES Act programs that have also been charged to current federal awards. You can't do that. Even though the PPP is not subject to single audit, we must look at PPP funds to determine if any of those loan funds were then also charged, expenses charged to the PPP loan funds were also charged to current federal awards. Keyword number 8, contribution. Keyword number 8, contribution. Write it down. Make sure that you have it so when you do your evaluation, you can write down all the key words. Okay, let's move on. Now, we discussed briefly SAS 134 in the previous set. We're going to take a deep dive into it just after this, so we're going to skip these slides. And also 140, we covered 140 in the past session. That was the one where they made amendments to section AUC section 935. We talked about earlier today the AICPA Audit and Accounting Guide not-for-profit entities. This is an AICPA audit guide. This is not an audit and accounting guide. It's entitled Government Auditing Standards and Single Audits. This one is published annually. The latest edition is the 2020 edition. We are expecting the 2021 edition during the summer. The summer doesn't have long to go, another month. So we're hoping it comes out in the next few weeks. The 2020 edition incorporates the 2018 Yellow Book, Government Auditing Standards. It also incorporates the concepts included in the 2019 Compliance Supplement, which includes the 6 requirement mandate that we discussed earlier, and the rewrite of internal controls in the 2019 Compliance Supplement. It does not include any COVID-19 considerations. These will be in the 2021 Audit Guide. The 2020 Audit Guide includes slight updates to the Yellow Book report illustrations, and there are no changes to the single audit report illustrations other than updating certain footnotes. It does include an appendix that summarizes the SASs from 134 to 141. The AICPA is in the process of updating report illustrations for financial statement reports, Yellow Book reports, and single reports, and they will be incorporated into the 2021 Audit Guide due out this summer. And just briefly on the 2018 revision to government auditing standards, or the Yellow Book, it is applicable for periods ending on or after June 30, 2020. So that would have meant June 30, 2020, September 30, 2020 year ends, December 31, 2020 year ends, and moving forward. So it's already in effect. These are the areas with significant changes or clarifications. Just quickly to run through them. It does have a new format and organization. They've combined certain chapters. They've broken out certain chapters. I think the best change that I've seen in this Yellow Book is that requirements are in a box. So you can clearly see that this is a requirement, followed by explanatory and illustrative material, which then would be followed by another box, which would be a requirement, et cetera, et cetera. So the way to read this is first to read the full Yellow Book. Obviously, if you're not involved, don't read the chapters on attestation engagements and performance audits, but read the Yellow Book. And then if you want to reread a certain section and just reread the requirements, you can pick them out by looking for the boxes. It talks about non-independence requirements, non-audit independence requirements. Specifically, it clarifies that if an auditor prepares financial statements in their entirety, whatever that means, and I don't take the word entirety literally, you can prepare the financial statements and most of the notes, but the client prepares one note, I'd still say that's preparing financial statements in their entirety. If the auditor does that, that creates a significant threat to independence requiring safeguards. If you prepare parts of the financial statements, you assess the threat for significance and then determine whether or not to apply safeguards. No significant changes to CPE. There's a provision about being a member of another CPE type of program like the AICPAs and how that interacts with the GAS CPE requirement. I'm sorry, that's the peer review requirements. The CPE requirements, just some clarifications. The peer review, if you remember the AICPA peer review, and you get peer review through the AICPA, then how it interacts with the GAS or Yellow Book peer review requirements. Internal control has been changed to comply with other changes that have come through in the previous years from for example, the UG and the compliance supplement. It introduced a new term called waste, which actually was carved out of abuse. You can tell from the examples, but we do not have to look for waste or abuse. But if we come across it, we have to determine whether we want to report on waste or abuse. There is no requirement to do so. And it also introduced reviews of financial statements into the Yellow Book. Also, just a little glitchy change subsequent to the Yellow Book coming out. There was a technical update which changed the reference from the term skills, knowledge, and experience to skills, knowledge, or experience, which makes more sense. Remember, management has to have the audit team has to have the skills, knowledge, or experience to conduct the audit, and management needs to have the skills, knowledge, or experience to oversee non-audit services. And with that, we're done with that session, but we're not taking a break. Not because we're being punished, that we weren't scheduled to do a break. We are running behind by about 15 minutes. We'll probably pick up 5 minutes of that in this session, but we'll probably go a little bit after 12, probably about 10 after 12 or so before we finish this. And so let's start on this one. Now, somebody has written a question. Let's see what it is. Now, wouldn't I love to see a Yellow Book? Being a CPA and works at a county, I belong to nothing and get nothing. I survive on free CPE. Sigh. I used to be an auditor once upon a time. Yeah. I mean, if you really need a copy of the Yellow Book, you can get them from the government publishing office. It used to be called the government printing office. And you can go on their website. They're very inexpensive. I don't think, I'm going to guess they run probably in the 20 some odd dollar range. So, I mean, if you really need it, that's the best way to get it. Or you can download it, come to think of it, from free on the GAO website. The only cost will be ink and paper. Okay, new audit report standard, SAS number 134. We saw this slide already. We've seen it twice, in fact. Just talks about the due date. Originally, periods ending on or after December 15, 2020, early implementation not permitted. Extended, periods ended on or after December 15, 2021, early implementation no longer precluded. Auditing Standards Board recommends that they all be implemented concurrently. So let's start taking a look at it. SAS 134 supersedes the following sections of SAS 122. Section 700, on forming an opinion and reporting on financial statements. 705, modifications to the opinion in the independent auditor's report. Understand there are three types of modifications: qualified opinion, adverse opinion, disclaimer of opinion. Section 706, emphasis of matter paragraphs and other matter paragraphs in the independent auditor's report. More on that at the very end of this session. It also adds a new section 701, communicating key audit matters in the independent auditor's report. We'll give some coverage to that in just a little while. It also amends quite a number of sections of SAS 122. I won't read all of them, but it does amend 210, terms of engagement, 230, audit documentation, 240, consideration of fraud, 260, the auditor's communication with those charged with governance, 300, planning, and a whole series of other. It also amends SAS 132, the auditor's consideration of an entity's ability to continue as a going concern. And you should pay particular attention to this and take a careful look at AUC section 570 with the same name. SAS 134 will impact not only the auditor's report on the financial statements, which is what it's geared at, but the engagement letter, because it does modify terms of engagement, the management representation letter, and the auditor's communication with those charged with governance. I have one slide on that at the end of this session. Keyword number 9, lease. L-E-A-S-E, lease. Give you a few seconds to write that down. Keyword number 9, lease. Okay, everyone got it? Let's move on. So here are the basic changes. Let's call them the major changes in the auditor's report. The opinion section will be presented first, followed by the basis for opinion section. Up until now, where was the opinion in a standard auditor's report? It was at the bottom. After an introductory paragraph and explaining what an audit's all about, after that it would say, in our opinion, blah, 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 blah. Okay, that has changed. Now the opinion section, as you will see shortly, is presented right up top, followed by the basis for opinion section, which will include a statement that the auditor is required to be independent of the entity and to meet other ethical responsibilities. Now, basis for opinion section in the past has been required only for a modified audit report, qualified adverse disclaimer, but not for an unmodified audit report. Now, it is required for all audit reports. 134 also provides a framework for auditors of non-issuers, meaning that would include all nonprofits, to communicate key audit matters, or KAMs or CAMs. Now, understand that the communication of key audit matters is not required for audits of non-issuers. Not required. But if the terms of the engagement include reporting on key audit matters, the auditor would be required to follow the new AU section 701 and communicate their findings in a separate key audit matters section of the report. Now, you may know that the SEC and the PCAOB require the communication of what they call critical audit matters, required for issuers, meaning publicly traded companies. They call it critical audit matters, or CAMs. We call them, CPA calls it key audit matters, or CAMs, but the difference is critical audit matters for issuers required, key audit matters for non-issuers not required. The SAS also expands the description of the responsibilities of management for the financial statements to include management's responsibility to evaluate whether there are conditions or events that raise substantial doubt about an entity's ability to continue as a going concern. It also significantly expands the description of the responsibilities of the auditor and key features of the audit, including references to the auditor's responsibility to conclude on an entity's ability to continue as a going concern, and the auditor's responsibility to communicate with those charged with governance. Now, one thing I didn't say when a few slides ago, SAS 134 is the first significant change in the standard auditor's report since SAS 58, which was issued sometime around 1988, something like that. So that's 33 years ago. And in fact, you might recall that in 1988, when SAS 58 came out, it was the first significant change in the auditor's standard report since 1948. So this is the second significant change in 83 years, or 73 years. Yeah, 73 years. So that's all. That's a long. So this is really important. So let's take a look at an illustration of an auditor's report. Now, in this first illustration, I'm going to use a for-profit entity. And here are the circumstances. This is the result of an audit of a complete set of general purpose financial statements. They are comparative statements, and the audit is not a group audit, meaning it's not a consolidation. Management is responsible for the preparation of the financial statements in accordance with GAAP. The terms of the engagement reflect the description of management's responsibility for the financial statements. The auditor has concluded that an unmodified opinion is appropriate. Based on the audit evidence obtained, the auditor has concluded that there are no conditions or events considered in the aggregate that raise substantial doubt about the entity's ability to continue as a going concern. And lastly, the auditor has not been engaged to communicate key audit matters. Now, we're going to, later on in this session, look at the wording if we do conclude that there is a substantial doubt about the entity's ability to continue as a going concern. And we will take a brief look at the wording if we have been engaged to communicate key audit matters. But as of now, neither of those apply in this illustration. Let's look at the report. So it's headed up Independent Auditor's Report. That's required. The first major subheading is report on the audit of the financial statements. Now you'll notice there's a footnote 1 there. Let's jump ahead for a moment to footnote 1. That subtitle, report on the audit of the financial statements, is unnecessary in circumstances in which the second subtitle, report on other legal and regulatory requirements, is not applicable. So if I go back to the end of the audit report just for a moment, there you see that second subtitle, report on other legal and regulatory requirements. All footnote 1 is saying is, if we do not have this section, report on other legal and regulatory requirements, if it's not there because it's not required, then we do not need this first subtitle, report on the audit of the financial statements. Okay, first section, headed up opinion. Again, these headings are required. And here's how it reads. We have audited the financial statements of ABC Company, which comprise the balance sheets as of December 31, 2021 and 2020, and the related statements of income, changes in stockholders' equity and cash flows for the years then ended, and the related notes to the financial statements. And by the way, no change there. That has not changed from the previous report. In our opinion, the accompanying financial statements present fairly in all material respects. the financial position of ABC Company as of December 31, 2021 and 2020, and the results of its operations and its cash flows for the years that ended in accordance with accounting principles generally accepted in the United States of America. There's no change in the wording there, but the position of that sentence, that paragraph, is now, instead of at the end of the opinion report, it is now up front at the beginning. Followed by basis for opinion. We conducted our audits in accordance with auditing standards generally accepted in the United States of America, GAAS. Our responsibilities under those standards are further described in the auditor's responsibilities for the audit of the financial statements section of our report. We are required to be independent of ABC Company and to meet our other ethical responsibilities in accordance with the relevant ethical requirements relating to our audits. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our audit opinion. Most of that has been there. The new wording is on the fourth line, starting with "we are required," that whole sentence going up to "relating to our audits," that whole sentence, "we are required to be independent, meet our other ethical responsibilities." That's all new. Now we get to the section entitled Responsibilities of Management for the Financial Statements. The first paragraph has no change at all. Management is responsible for the preparation and fair presentation of the financial statements in accordance with accounting principles generally accepted in the United States of America, and for the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of financial statements that are free from material misstatement, whether due to fraud or error. As I said, no change there. The next paragraph is new. In preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about ABC Company's ability to continue as a going concern for, and then you put the period that's set by the applicable financial reporting network framework. It would probably be for the year ended, whatever the year is. And that's new. Now we get to the greatly expanded auditor's responsibilities for the audit of the financial statements. This first paragraph is mostly new. Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Reasonable assurance is a high level of assurance, but is not absolute assurance, and therefore is not a guarantee that an audit conducted in accordance with GAAS will always detect a material misstatement when it exists. The risk of not detecting a material misstatement resulting from fraud is higher than for one resulting from error, as fraud may involve collusion, forgery, intentional omissions, misrepresentations, or the override of internal control. Misstatements are considered material if individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users made on the basis of these financial statements. As I said, that is mostly new. Continuing with the auditor's responsibilities. In performing an audit in accordance with GAAS, we exercise professional judgment and maintain professional skepticism throughout the audit. That's new. Identify and assess the risks of material misstatement of the financial statements, whether due to fraud or error, and design and perform audit procedures responsive to those risks. Such procedures include examining on a test basis evidence regarding the amounts and disclosures in the financial statements. The new wording in that paragraph begins on the second line, which says, and design and perform audit procedures responsive to those risks, and the remaining part of that paragraph. That's new. Obtain an understanding of internal control relevant to the audit in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of ABC Company's internal control. Accordingly, no such opinion is expressed. That's been there before, but it's been significantly reworded. Let's go to footnote 2. In circumstances in which the auditor also has a responsibility to express an opinion on the effectiveness of internal control in conjunction with the audit of the financial statements, and Client could retain us to, in addition to reporting on the audit, on the financial statements, express an opinion on the effectiveness of internal control. Usually not done by nonprofits, but it could be. But if it is, then we would eliminate or omit the following, but not for the purpose of expressing the opinion on the effectiveness of ABC Company's internal control. Accordingly, no such opinion is expressed. Now, that's going to be a rare occurrence, but it could happen. Fourth bullet, evaluate the appropriateness of accounting principles used and the reasonableness of significant accounting estimates made by management, as well as evaluate the overall presentation of the financial statements. That's also been reworded. Conclude whether, in our judgment, there are conditions or events considered in the aggregate that raise substantial doubt about ABC Company's ability to continue as a going concern for a reasonable period of time. That is obviously all new. Still continuing on auditor's responsibilities. We are required to communicate with those charged with governance regarding, among other matters, the planned scope and timing of the audit, significant audit findings, and certain internal control related matters that we identified during the audit. And that is all new wording. Then we get to that second major subtitle, Report on Other Legal and Regulatory Requirements. And here's what that is. First of all, it says the form and content of this section of the auditor's report would vary depending on the nature of the auditor's other reporting responsibilities. If we jump to footnote 3, it says an example would be other reporting required by government auditing standards, that is, the GAS or Yellow Book report on internal control over financial reporting and compliance. So if this is a Yellow Book audit, we'll have that requirement. And there'll be a paragraph there. Remember, all single audits are by definition Yellow Book audits. Then the signature of the firm, no change there. The city and state where the auditor's report is issued. I will remind you that if your city and state is in your letterhead on the first page of the audit report, you don't need to repeat it down here. But if you have more than one office, and they are both listed on the letterhead, then you need to have the city and state where you've issued the report down here below the audit firm's signature, and then the date of the audit report. Remember that an audit report on financial statements is dated no earlier than the date when you have sufficient appropriate audit evidence to support the opinion. Now, before this SAS 134, I would guess that most audit reports ran one page. Now, even a standard report with no findings, no modifications, no other paragraph, nothing, no going concern issues, is going to run at least 2, if not into a 3rd page. So there's a significant expansion of the auditor's standard report. Now, talking to some of the clients out there of Freed Maxick, a lot of you now you will see what an auditor's responsibility encompasses. There's a lot of things that auditors need to do in order to get to a point of expressing an opinion on the financial statements. An auditor's report on financial statements. Now we're going to talk about an illustration of an auditor's report. Now we're going to jump to a not-for-profit entity for a single year. Remember, we just did a for-profit entity for two comparative years. Now it'll be a single year of a nonprofit. Again, circumstances are the same as in the first illustration, except it's a single year. And importantly, we have prior year summarized comparative information derived from audited financial statements. These are not fully comparative. They are just summarized comparative information from the prior year. And all references from the first illustration to ABC Company in this illustration will refer to XYZ nonprofit organization. And here's how it reads. Starting with the opinion, is that the headings remain the same. We have audited the financial statements of XYZ nonprofit organization, which comprise the statement of financial position as of December 31, 2020, and the related statements of activities and cash flows for the year then ended, and the related notes to the financial statements. In our opinion, the accompanying financial statements present fairly in all material respects. the financial position of XYZ nonprofit organization as of December 31, 2020, and the changes in its net assets and its cash flows for the year that ended in accordance with accounting principles generally accepted in the United States of America. The basis of opinion remains the same. The responsibilities of management and the responsibilities of the auditors remain the same. And now we come down to report on summarized comparative information. We have previously audited XYZ nonprofit organizations' 2019 financial statements, and we expressed an unmodified opinion on those audited financial statements in our report dated May 15, 2020. In our opinion, the summarized comparative information presented herein, as of and for the year ended December 31, 2019, is consistent in all material respects with the audited financial statements from which it has been derived. So since we don't have fully comparative financial statements, we cannot opine on 2019's financial statements being fairly presented in accordance with GAAP. But we can say that in our opinion, the summarized comparative information is consistent with the financial statements from which we took them, which is what this is doing. We talked about communicating key audit matters, and we said that AUC Section 701 provides guidance should we be retained to report on key audit matters. But right now, I don't think that's going to be a common occurrence. It could down the road become more common. Right now, not so much. But let's talk about what's there. AUC Section 701 provides guidance on the auditor's responsibility to communicate key audit matters in the auditor's report when the auditor is engaged to do so. It addresses really two things: the auditor's judgment about what to communicate and the form and content of the communication. It defines key audit matters as those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period. Notice, current period. Even if we have comparative statements, fully comparative statements, key audit matters only address the current period. Key audit matters are selected from matters communicated with those charged with governance. And what that means is, if you, the auditor, decide that whatever it is we're talking about is not going to be communicated to those charged with governance, it cannot be considered a key audit matter. Keyword number 10, asset. A-S-S-E-T, asset. This isn't a question, but one of the participants paid me a compliment, so I'm going to read it. It says, "Perfect. I'm having a great info collecting day. Thank you." And I thank you for that comment. It makes me feel good that at least one person out there thinks that this is beneficial. Let me tell you, it is not as enjoyable as a speaker talking to a computer for this morning only 4 hours, but on an all-day seminar, which I do sometimes for almost 8 hours, it's not as enjoyable as being there in person and watching faces and interacting with people. So who made that comment, I won't say the name. Thank you very much. It's greatly appreciated. Keyword number 10, asset. And let's move on. So now we're going to look at an illustration of the auditor's report dealing with key audit matters. We've been retained. The circumstances are the same as in the first illustration, except the auditor has been engaged to communicate key audit matters. So let's look at the wording. So the sections opinion, basis for opinion remain the same. Right after the basis for opinion section comes a section headed up key audit matters. And obviously these are all new. Key audit matters are those matters that were communicated with those charged with governance and, in our professional judgment, were of most significance in our audit of the financial statements of the current period. These matters were addressed in the context of our audit of the financial statements as a whole and informing our opinion thereon. And we do not provide a separate opinion on these matters. And then it says, to describe each key audit matter in accordance with SAS 134, Section 701, communicating key audit matters in the independent auditor's report. The wording of how you communicate, what you actually say for each key audit matter, is really a matter of professional judgment. But in determining which matters to communicate with those charged with governance are key audit matters, the auditor should look at three things. So we've communicated with governance. We've communicated matters with governance. That's required. It's required communication with those charged with governance. Which of those are key audit matters? Remember, if it's not communicated with those charged with governance, it cannot be considered a key audit matter. So we've communicated matters to those charged with governance. Now we have to think of which are areas of higher assessed risk of material misstatement and significant risks that have been identified. Areas in the financial statements that involve significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty, and the effect on the audit of significant events or transactions that occurred during the period. Now, I can think of one that should be in every audit report: COVID-19. Wouldn't you think that the effect of COVID-19 on the audit is a significant event? So that's something I think we're going to find commonly once this is the new standard is adopted, which has got to be for your December 31, 2021 year ends. But those that implemented as of December 31, 2020 or June 30, 2021, which is now permitted, it's early implementation, but it's permitted. I think COVID-19 should be a key audit matter if you're retained to communicate key audit matters, which is not likely. The auditor should describe each key audit matter using an appropriate subheading in a separate section of the auditor's report under the heading Key Audit Matters. We saw that here. Unless law or regulation precludes disclosure about the matter. And I think you'll find that more in the government world, less so in the nonprofit or for-profit world. Or the auditor determines that the matter should not be communicated because the adverse consequences of doing so would reasonably be expected to outweigh the public interest benefits. Okay, I'm not sure how that would apply, but this is in the standard, so keep it in mind. The description of each key audit matter should include a reference to the related disclosures, if any, in the financial statements, and should describe why the matter was considered to be one of most significance in the audit and how the matter was addressed in the audit. So what they're saying here is, if in discussing this key audit matter, there's something in the notes to the financial statements about it, keep that in mind in writing in your audit report why the matter was considered to be one of most significance and how it was addressed. And it could very well reference the note. There's nothing wrong in an audit report referencing a note to the financial statements. The auditor should not communicate a matter in the key audit matters section of the auditor's report when the auditor would be required to modify the opinion as a result of the matter. What that simply means is that if there's a matter that you come across that would result in a qualified opinion, and you're going to cover that in your basis for opinion and then in your opinion section, that does not need to go in the key audit matters section. Matters giving rise to a qualified opinion, or when substantial doubt exists about an entity's ability to continue as a going concern for a reasonable period of time, are by their nature key audit matters. However, these matters should not be described in the key audit matters section of the auditor's report. So you have a qualified opinion, that's a key audit matter. You have a substantial doubt about ability to continue as a going concern, that's a key audit matter. But you're not going to describe these in the key audit matter section of the report. If you have these situations, the auditor should report these matters in accordance with the applicable AUC sections. So you're going to report your qualified opinion in the opinion section and the reason for it and the basis for opinion. If it's a going concern, you can report it in the going concern section, which we haven't covered yet, but we will. And then you'll include a reference to the basis for qualified opinion or the going concern section in the key audit matter section. So you're not going to report them as key audit matters, but in the key audit matter section, you're going to reference them where you do report them, either basis for qualified opinion or the going concern section of the report. AUC section 705 provides that when the auditor expresses an adverse opinion or disclaims an opinion on the financial statements, the auditor's report should not include a key audit matter section, period. If you disclaim an opinion, which basically says we didn't really do the audit, and we give reasons why not. We didn't complete it, but that's not the wording we use. How can you then report on key audit matters if you have no opinion on the financial statements? If the auditor determines that there are no key audit matters to communicate or no other key audit matters to communicate, the auditor should include a statement to this effect in the key audit matters section of the auditor's report. And you'll use one or the other of this. They're mutually exclusive. If you determine you retain to report on key audit matters, you determine there are no key audit matters to report, you would then say in your key audit matters section of the report, after the introductory paragraph, we have determined that there are no key audit matters to communicate. If you have a qualified opinion, which remember is a key audit matter, and no other key audit matters to communicate, after the introductory paragraph in the key audit matters section, you would say, except for the matter described in the basis for qualified opinion section, we have determined there are no other key audit matters to communicate. SAS 140, remember we covered that in the AM.